Hi there, everyone. I'm Rob McClellan, Senior Fellow at the Tax Policy Center, and I wanted to welcome everyone to the 14th IRS TPC Research Conference on Tax Administration. And I want to thank Brett Collins for leading the committee to put together this program. It's great to see old friends and faces here face-to-face at Urban, and I'm glad that so many could also attend virtually. This year we have about 600 people signed up to be here in person or virtually, which is a testimony to the importance and ongoing interest in tax policy and administration. This year is particularly interesting both because of the continued effects of the Inflation Reduction Act and the Tax Cuts and Jobs Act and the expiration of some parts of the Tax Cuts and Jobs Act at the end of 2025. And of course, the increased budget for the IRS has helped with enforcement and administration, and we hope that continues into the future. We have a really outstanding program today consisting of 4 sessions. In the first, we'll hear about the use of tax data to improve research, such as appropriately linking tax and other data sets. The second focuses on the modeling and estimation of tax avoidance behavior. The third session turns inward and discusses IRS performance and methods for improving it, including the use of new technologies. The final session continues that inward view, and it discusses more specifically how that filing burden, or how the filing burden can be reduced. We're delighted to have as our keynote speaker today IRS Commissioner Danny Werfel, who will be interviewed by Tracy Gordon, Director of TPC. I want to turn the microphone over now to Barry Johnson, Chief Data and Analytics Officer, Research Applied Analytics and Statistics for the IRS.
Thanks, Rob, and good morning to everybody. It's a real pleasure to be here with you for this 14th annual conference. I want to start by just thanking Tracy Gordon and the Tax Policy Center for once again partnering with us on this event and for hosting us in this beautiful facility and arranging all the online technology as well. RAS and the IRS gain so much from the work that we do with the Tax Policy Center and from the work that the center does itself. And this research conference is always a highlight of the year for me. Thanks also to Rob, who has been our main contact for the conference this year and served on the program committee. And thanks to Alan Plumley, who for many years fostered this event, and for Brett Collins, who has taken over as the program lead for us. As Rob mentioned, the IRS Commissioner will be here later today, and what he's going to tell you is that it's a really exciting time to be at the IRS. The transformational funding provided by the Inflation Reduction Act is starting to bear fruit all across our organization. The additional staff and resources have allowed us to extend our goals for level of service on the phone and to offer extensive in-person assistance to taxpayers at our reopened walk-in centers and through extended hours on weekends and evenings. We've also introduced new online options to taxpayers who want to manage their tax issues in that format and have many new options planned before the next filing season. We're making progress digitalizing paper across the enterprise, and that's eventually going to lead to new data to support the research community. And finally, like everyone these days, we're actively exploring ways to use artificial intelligence to improve service to taxpayers, make employees more efficient, and refine our compliance programs. Data and analytics are playing a tremendous role in supporting all the work that's going on in the IRS. In fact, RAS is currently supporting more than 140 different IRA-related initiatives across the enterprise. Our partners in the embedded research functions are also working hard on the transformation. And across the service, we're hiring data scientists, social scientists, and IT professionals to assist in this work. They're working on a wide range of issues, some of which you're going to hear about today. And if you or anybody you know is looking for rewarding opportunities to use your skills to improve our tax system, we'd love to talk to you. So before I turn this over to Brittany Jefferson to lead us into our first session, I want to explicitly thank all the authors and presenters on today's program. We're really fortunate to once again have a wonderful set of papers that touch on major aspects of our transformation. Thanks also to each of you in the audience for your active participation in today's question and answer sessions. Your feedback and suggestions are essential for helping to ensure the quality of our work. And finally, I want to note that this is the first year I've attended this conference where Eric Toder wasn't present, either representing a research function in the IRS or the TPC. I'm hoping he's out there listening virtually, and I want to thank him personally for all he's done in support of RAS and tax research, and for all he's going to continue to do from his new base of operations in Maine. So thank you for the opportunity to spend a few minutes with you this morning, and I'm looking forward to chatting with you during the breaks.
Okay, good morning, everyone. My name is Brittany Jefferson, and I'm here from the Taxpayer Services Division of the IRS. We have some very interesting papers for our first session today, which is Harnessing Data for Better Research. Now, as most of you know, we live in a world where data is plentiful, but does not always lead to actionable results. So this first session is all about how we can actually use the data that we find to conduct meaningful research with useful results that will give insights into how to better serve the taxpayer. First, we are going to have Amy O'Hara from Georgetown University. Sorry, just looking at my notes. And Amy is a research professor from the McCourt School of Public Policy. Amy works on data governance, linkage, and privacy-preserving technologies, and she's going to present the paper, Improving Linkages to Individual Income Tax Data. Next, we'll have Carl Sanders and his colleagues. Carl is an economist from the U.S. Census Bureau working in measurement issues in income and occupation. He will present the paper, A Large-Scale, High-Quality U.S. Occupational Database, Results from Merged IRS and ACS Write-ins. And then finally, we are going to have Biz Bedane, an economist from the Research, Applied Analytics, and Statistics Division of the IRS. And he is going to present the paper, Disaggregating Tax Compliance Burden, a Comparative Study. So each of our presenters will have 20 minutes to present, and then we'll all come back on stage with our discussant, Lynn Berman. And he will discuss the papers, and then at that point, we will take questions from the audience. So with that, I will welcome Amy to the stage.
All right. Thank you. We're very excited to be here and to be kicking off this year's conference. And I'm going to be talking to you about a project where we're trying to improve linkages to individual income tax data. And many of the projects that occur within IRS and in Treasury, they are linkages within tax data. And here we're talking about having clients bringing data to the service so that they would get their data linked. And it's with colleagues at Georgetown, and we are doing this to inform IRS. So what we want to look at are how to improve linkages when especially you don't have Social Security numbers or TINs. So there's a lot of unmet need for these linkages, especially from state and local agencies. They run a lot of programs that they would like to measure outcomes, whether that's for labor force participation. They want to understand how people are accessing benefits like the EITC or child tax credit. And in our project, we're trying to figure out how we could improve the way that the data are prepared, transmitted, linked, tabulated, and then disclosure proof so that you would be able to get aggregate statistics back to these folks that need to measure these outcomes. So what we're calling this is a secure query system, or SQS. And SOI is exploring design options for how they could operate a query system that would allow for these repeatable, efficient, secure data linkages that would only produce aggregate statistics back to these folks. There are several key features here. The first is that the data validation would occur on the client side. So there have been projects occurring within IRS where clients like state health and human services departments have their data sent in. But if the data aren't clean or formatted, that cleanup is happening inside IRS. So one of the ways this project is changing this approach that had been occurring previously is by having the clients validate their own data. That means getting them to take their input data and get it to conform to a common data model that will aid in linkage. That means identifying all of their identifiers, parsing names, standardizing addresses, and also understanding the degree to which they have missing or corrupted data in those fields. Another aspect of the SQS is that the administrative functions will be handled by an intermediary. In this case, in the short run, it's going to be Georgetown University. And I stress that because we don't anticipate doing this forever. We would love to see this sort of function transferred up to something like a national secure data service. Many of you know that that's one of the aspects of the Evidence Act. And there was a committee that Barry Johnson and I both served on trying to figure out what would the characteristics of a national secure data service be that would aid in data linkage and privacy preservation to support evidence building like we're describing here? So the administrative functions that we're talking about, this is data sharing agreements, data transfer agreements, understanding the terms and conditions on what inputs are allowed and what outputs you're going to get, in addition to all of the security in being able to have managed file transfers from those organizations, those government agencies that would need to be moving their data to IRS. There would be development of matching processes, which is really the core of what I want to talk to you about today. And those matching processes would be run within SOI by SOI employees. This is not something where we're talking about transmitting the data to a trusted third party or another government agency. This would all have to happen within SOI. Once they have the client data and they get it decrypted, they need to tabulate these predefined statistics, which is really probably the biggest innovation in SQS, is that this is not a choose your own adventure. If you're a State Department of Health and Human Services, you're going to get that table of output, not additional questions, not additional breakdowns that exceed the scope of tax data that we're talking about matching to. You're only going to get what is pre-approved in the system, which is how it can be scalable, how it can be repeatable, and how we're going to learn from earlier demonstrations on how to continue to refine and improve this process. Finally, once statistics are produced, if a client brings a data set and it doesn't have a complete match, you might have cell sizes too small. So in the short run, we're thinking that SQS is going to use traditional statistical disclosure limitation methods, and that would include things like suppression and rounding, nothing out of the ordinary. But in the future, we anticipate as usage scales, we're going to have to explore things like noise infusion, especially if you have a great interest or states having overlapping populations in different samples that they're providing. So this is kind of the core of what we're talking about, this query system where you have all of these people with unruly data, how you're going to bring that and get it matched efficiently in an automated fashion. We've spent nearly 2 years talking to folks in these organizations. And so this would include research organizations that have run previous experiments. These are state and county departments, and their officials say a lot of our data have social security numbers. Sometimes within a file, we have 60% with socials, 40% without. Our natural question, how good are those 60% that you do have? And they're like, I don't know, we don't check. And I'm like, well, you're matching it to something, or are you validating it? So there is a lot of concern about the quality of the identifiers that are in these files. We know that we're going to have to use different combinations of personal identifiers, and we're also likely to use both exact and probabilistic matching methods depending on the information that is in the file that the different clients are going to be providing. We also want to think about the sort of information that we can reflect back to the clients, especially to improve their data hygiene for the next time they want to use the SQS. So we want to be able to tell them, you submitted a file that had this many records with what you thought were complete socials, and to be able to provide back aggregate statistics, nothing at the individual level, but aggregate statistics so they know whether they have the degree to which they are likely to have bias in those resulting statistics that they will get. So what are we talking about linking to? For person-level linkages for this project, we're talking about two different match targets. One is going to be taking client data and matching it at that individual level to a subset of information returned. So here we're talking about the 1099 NECs and the W-2s. We also want to look at matches to the 1040, and that's largely to look at things like credit participation and sometimes looking at AGI instead of those summed income amounts from those information returns. However, when you're looking at these, there's not the same exact information on identifiers available across these different forms, and it isn't parsed the same way. And parsing, I mean, if I wrote my name in the field and I said, it's Amy O'Hara, Do you pull apart Amy and O'Hara? And then what do you do with the hyphen or the apostrophe in my name? What do you do with people who have hyphenated names? So this is the sort of thing that we're in the weeds on, understanding the degree to which these different organizations have captured data and how it would align to what we have here. Okay, so this is an issue whenever we have name in one field as opposed to name broken apart, whether you have that apartment number embedded in the street address or separate, things like that. So there are also additional challenges when we're looking at matching to the IRS data, because in the CDW, the Compliance Data Warehouse, you're likely to have some amended returns, some late returns. You have information returns that are going to have different name address pairs than the client data may have. And you have lots of people with multiple jobs, so they're going to show up as different representations in that data set. And we have to figure out how we are going to review and address these discrepancies in an automated fashion. So what are the clients going to be bringing to the table? Some of them have SSN, some of them have bad SSN. All of them will have some amount of name data. And FN is first name, MI is middle initial, middle name, MN, LN, last name. It is unclear the degree to which they have scrubbed that, they have updated that, they have overwritten that, whether they have standardized that, dealing with maternal and paternal surnames, for instance. It's really about how they've captured that and then how well we are going to be able to align that to do both exact and fuzzy matching to the individual income tax data. They also have address most of the time. There is one small state to the northeast of us that for their school data, they didn't capture address. They only know the school district that kids are in. And we are quite surprised by that. And so we're going to have to figure out, one, in the short run, would you be able to create these catchment areas and have combinations of zip codes that you could use instead of street address? And number two, when you show them the results of how lousy that is, can you induce them to start capturing or retaining street address information that is likely to get you a much, much, much better match? So some of this is training these clients that are listed in that bottom box. That's just an example of the sort of potential clients that you would have here. So some of these organizations have also captured date of birth, spouse, parent guardian information. You can imagine that that would be really helpful if you're going to be doing some matching. But in our first pass for the MVP for this project, we are not going to be using the information that I've listed there in the fourth bullet, but think about that as ways to improve the ability to discriminate between potential multiple matches that are happening whenever you take these client data sets and match it to the tax data. So just to pull out some of those features in that bottom box there, there's great interest from education, from Health and Human Services, about housing programs. These are organizations that want to understand whether different interventions or policies that they have implemented have affected the group in their cohort that they would potentially submit. So for our project, we have been looking at ways that we would test different match approaches. And so I already said exact and probabilistic. Here I'm talking about the nuts and bolts. Are we using last name or using middle initial, using middle name? Are you going to do blocking whenever, in other words, blocking is you have the entire country. I want to look for Amy O'Hara only in the zip code where she lives in Montgomery County. Do you look for that 5-digit zip code? Do you look within the 3-digit zip code? There are different ways to make the search space smaller so that you have a more efficient match and hopefully a more accurate match. There is a data set developed by the University of Washington called PseudoPeople, and I encourage you to look at this because this is a great project. It was funded by a Department of Commerce cooperative agreement, and they have created fake data sets for the population of the United States. This includes fake 1040s, fake 1099s, fake census data, fake WIC data, women, infants, and children, and fake SSA data, resembling the NUMIDENT, the register of all SSNs issued. And so we took a subset of this and we looked at how that could resemble the identifiers that clients would be bringing to the table. And we took the fake Connecticut data that had the 1099s and the 1040s, and we didn't want to match good fake data to good fake data, so we corrupted it. And there is a corruption tool that is developed by some researchers in Australia that I highly recommend. And we blanked out the data and made it messy in line with what the clients have told us. So right away, we don't expect a 99% match rate. Like, we're looking to see how the different combinations of identifiers weather the amount of corruption that we have put into the data. And so in the bottom bullet there, it shows that these are insertions and deletions and introducing misspellings or mishearing errors. So now we have fake data to match, and what are we going to match it with? There are a lot of different ways that you could do this. Many of them are open source. There's FastLink, there's Splink, there's old things like ChoiceMaker. There's a new open source tool coming out of USC that really focuses on looking at families together when you're doing linkage. But we chose Splink. And this is a program that was developed by the Ministry of Justice in the UK to do government-wide data linkages on administrative data. So this thing was built for speed, built to scale, and built so that you can go in there and say, oh, that's a character string. What sort of string comparator am I looking for? And how precise do I need that match to be? So there's lots of information that you can go in there and kind of turn the dials. And we approach this with 22 different combinations of identifiers, many of which look very similar. We're looking at 4 characters of first name, 2 characters of first name, or only first initial. What gives you the best discriminating power, especially when you're matching against things that might have those insertions or miskeyings? And we did blocking both on zip 5 and zip 3, so that's 5-digit zip code, or the first 3 numbers of it. And we really pulled our information on what we were testing from the patient matching literature, where there are people saying, what are the ED, the emergency department data? What are the electronic health records? What are these insurance records? And so these are different ways that they have taken the data and made it into little pieces that you can tokenize and then seek a match on. So we were testing these match passes on those 2 corrupted files to the uncorrupted fake data. We aren't using any real data. Even though this says 1040, 1099, this is all fake data. And we evaluated each pass that we tried, looking at the true pairs from the fake data, right? Because they all had identifiers created by UW. This was a luxury that I have never in my career experienced, because I used to work at the Census Bureau and did a lot of matching. We never had a truth deck. And so we would simulate, like, these are the socials from CMS and these are the socials from IRS, and we believe them to be true. But using fake data is a way that you can actually say, I want to measure precision and recall. I want to see whether I found the right matches. I want to see which ones I've missed. And so using pseudo people, that we only use that sample from Connecticut, but this is something that you can do at scale for the whole country. And the pseudo people folks have tried to make it resemble the US by building in some migration patterns too. So that is an exciting data set to test with. So our preliminary results, and I say preliminary because we are really focusing on the corruption here, not so much on what do we expect the norm for organizations that would be bringing a file that has a lot of socials. That would be a much better pass than what we experienced with the corruption that we did. But we're thinking that these are some of the ones that we definitely want in there, but this is going to be a waterfall approach. So you're gonna have the data come in, you're gonna seek the most precise, tight match that you can get. If you fail that, you will move into a module where it is seeking a somewhat less precise match, or it's doing blocking on different variables, or ultimately it might do a match where you have no blocking at all. And that is something that our team was looking at the runtime. When you don't do any blocking and you're taking the entire tax file, that is going to be a very heavy lift computationally, potentially. We are, the nice thing about Splink is that you can run this in parallel, but there are so many ways that we want to continue testing this to see how we could recommend implementations of a program like that to make sure that it's both accurate and efficient. So the next steps are to test these matches on larger data sets. Like I said, we started out with a subsample of just their Connecticut. Let's do it on all of Connecticut. Let's match it to the Northeast there, so we see all of those people that live in Connecticut, work in New York City, and have different migration patterns there, and then move it across the country so that you can see people that may have started in Connecticut that have moved. we need to test this on lagged matches. We know that some of the clients are going to come in and say, I have data from 2018, but I really want to see those aggregate statistics. Show me mean income, mean earnings for 2023. That means that we are going to have name and address from that earlier period that we want to go and retrieve the TIN. And I say we, I mean SOI. They need to be able to go in and retrieve a TIN and then take that TIN and match it to the 2023 data. But you can't just immediately go match to 23 because it's an address from back in 2018. So there are lots of things that we want to continue simulating using the pseudo-people data. And also we want to create tables of the potential match statistics to give back to folks. When I mentioned before that one state that doesn't collect street address on all of its administrative data, to show them that this is what you would be able to get if you had included street address, to hopefully induce changes in the way that these clients are capturing and vetting and standardizing their data. We know that many organizations may not currently have the capacity to do that. They have staff that know how to run their programs. We all know how that is. But they may need tools or they may need training to take the administrative data that they are capturing and stewarding and take that and recode it into these different pieces of name address information. And so we want to make sure that that sort of assistance is available for them. Many of us believe that that would be the exact sort of technical assistance that would be great if a national secure data service could provide. I should have mentioned that Len was on that panel with us too. And we all believe that there is a need for that sort of information to be presented out to people so they know what the best practices are. They could be pointed to partners that may be able to help them get their data in shape. And so that is what we're building into the next steps. Ultimately, what the Georgetown team wants to do is to come up with a list of options, kind of a menu where SOI would be able to say, okay, if I'm gonna run in Python, maybe get this thing launched through R and get this running in Python, how does it look? There are other highly valued tools that are written in R, and there are these other ones that if you're really focused on 1040 and you do have that additional information on spouses, partners, and potentially dependents, you may be able to use that open source tool that has come out of USC to do better family level matching. And so there is a conference in September that all of these, Splink and the USC project, some matching at Census, it's a data linkage administrative data conference that is coming up. It's going to be in Chicago, September 15th. And so they're also doing a workshop on Splink. So if you like data linkage, this is a conference for you because you'll be able to see what your international peers are doing and also see real world examples, not the sort of fake data example that I am doing, but how other countries are doing these sort of studies at scale. And they do care about the match accuracy, they do care about the runtime and things like that. So I thank you for your attention. And if you have any questions or recommendations on what we should be doing, please let us know. Thanks.
Morning. I'm Carl Sanders. I'm excited to present this new project we're working on with researchers from the Census Bureau, IRS, and academic institutions on a large-scale, high-quality U.S. occupational database resulting from the merging of IRS and ACS write-ins. So the purpose of this project is to understand worker occupation at a large scale. So as you're undoubtedly aware, worker occupation plays a key role in economic and social phenomena like skill bias technical change and its impact on the economy, wage growth over the life cycle of individual workers, cross-sectional wage dispersion across workers, or the transmission of human capital from adults, parents to children. And there's been longstanding research on all these topics. If you've ever worked with, say, international data or maybe specific local data sets, in some cases there are data sets available at the more universe level that have occupation in them. So I'm most personally familiar with the country of Denmark, where occupation is reported by firms in their payroll system to the statistical agencies, and so is available basically for the universe. You're probably also, if you work in this field, familiar with the idea that there is no such data set in the US. If you've ever done sort of large-scale occupation work in the US, you've most likely used the American Community Survey, which is a fairly large, in absolute number terms, survey of the United States. Usually you get about 2 to 3 million worker occupations per year if you use the ACS. And they're numerically coded, so they're ready to use according to the census-specific coding system. You may also be familiar with filling out your 1040s, that there is a form, that there is an entry occupation, which I'll show you a little bit more in the future. And if you work for the IRS, you may know that this sits in a database. However, it's completely voluntary. Don't tell taxpayers, but there's no cost to not filling this out correctly. It won't be enforced in any way. It's just free text, and there's not a lot of quality control that's currently done. So the goal of this project is to use this field to create this large-scale, high-quality occupational database. Today, specifically, I'm going to talk about work we've done where we've merged at the worker level the ACS and IRS write-ins. So this will be a significantly smaller sample than the full IRS sample. But this will allow us to do 2 specific things. First, we are able to do quality control. So currently, the IRS data is just free text responses in a database. By linking it with the ACS, we're able to look and see how much, for instance, do they match? Are responses in the IRS data the same as responses in the ACS data? Are they different? What sorts of differences do we see? And how much those differences matter? Today, I'm going to talk just specifically about 2 ways we evaluate similarity. So first will be called token set similarity, or token set ratio. Token similarity is how the characters in the 2 write-ins are similar. So this will just be purely comparing, you wrote LZXY in one field, you wrote ABCD in the other. How do we evaluate the similarity of those 2 as a basic quality control? Of course, as we'll see, you probably want to be more interested in this semantic similarity of the 2 responses. What do the 2 write-ins mean? And we're going to do some work on that, and that's a more of a difficult question because there's no out-of-the-box way to evaluate the semantic similarity of 2 arbitrary text strings. As a way of solving this problem, the semantic similarity problem, and at the same time getting the ability to code up the entire IRS database, all what it would turn out to be around 150 million records per year, we develop a large language model-based autocoder that can take that of course automatically, can take text write-ins and map them to census occupation codes. Okay, consistent with, say, the ACS in a given year. I won't have time today to talk about it, but the ultimate goal of this is to just simply code up the entire IRS database for an arbitrary year and analyze things like what's the cross-sectional distribution of occupations that the IRS sees? What's the longitudinal change over time, even within worker, you could potentially do by linking tax records across the year. Okay, so this is the long-term goal that I won't be able to talk quite as much about today. As previously mentioned, the first data set we're going to use primarily is the American Community Survey. So for today, I'll be talking about the 2019 one-year microdata, the write-ins, which I'll show you a little bit more in a second. And second, IRS tax year 2018, the Form 1040s, which again, I'll show you in a second. Just as a quick note, tax year 2018, these people are filling out the forms in 2019, hopefully. And so these would be sort of closest equivalent that we're going to be able to get. So when I say write-ins, what do I mean? So here's a brief overview of how the ACS and IRS do occupation write-ins. This is only a subset of what the ACS does, but also gets you the general idea. It's a little small for those in the room. So the top question is, what was this person's main occupation? And they can just write in something. So in this example, this person wrote in driver. There is then a follow-up field. What were the main duties associated with this occupation? So there's an imaginary response, pick people up in my car, drive them where they need to go, and drop them off. Unfortunately, in practice, they usually don't get that much information, that much detail. I really hoped you would see like these beautiful long descriptions of everything people do. Often they will write driver and driver, and then that's it. In contrast, the Form 1040, this is the paper version, just by where it has the signature field. By where it has a signature field, it says your occupation, and people can voluntarily write in a text field, spouse occupation. So the top line would be the filer, then the filer's potential spouse occupation, which they, again, can write or cannot write. Okay, but there's no actual specific instructions. Different tax software, unfortunately, provides different instructions for this field, and so it's a little ambiguous what people think they're actually writing. So the first way we're going to compare these two entries, in particular, I'm going to compare the main occupation from the ACS to the write-in for the IRS after linking these workers and spouses with their ACS records. It's called the token set ratio. This is simply just a number between 0 and 100 that says how similar are two strings, taking into account the characters that are in the string and the order of those characters. So just for some simple examples, thankfully, the best possible score would be if someone wrote lawyer in the ACS and wrote lawyer in the occupation field in the 1040, they would receive a score of 100 for those paired responses. If the write-ins had very few characters, here I think they have one character in common, and not even necessarily in the same order, they will receive a very low score near 0. Okay, so ideally this would be just, this is a very simple, fast formula to run, even for a very large scale. Unfortunately, it has two weaknesses that you can probably guess. First of all, high semantic similarity does not imply high token set similarity. In the US, lawyer and attorney are synonyms. They only receive a token set ratio score of 29. In contrast, high token set similarity does not imply high semantic or job similarity. Paralegal and paramedic share a number of characters in the same order, but of course they're completely different jobs. They share effectively nothing in terms of what people do. Okay, so with these weaknesses in mind, I'm going to show you the results we get from token set ratio and then try to address these weaknesses with the semantic similarity measure. All right, so here's a histogram, histogram, kernel density plot with the left-hand side of the horizontal axis being very bad matches, all the way to the perfect matches on the right-hand side. The median token set ratio score for our paired data set is 57, but you can see that median is going to mask a bimodal distribution. There appears to be a large number of observations or large number of paired observations that are bad matches, broadly speaking, with scores between 20 and 40, then a sort of steady low number in between then. And it's difficult to even show this because of disclosure avoidance issues, but 33% of the data set actually just has the same or token set ratio 100 entries between the two fields. So this would be lawyer in the ACS and lawyer in the IRS data. Okay, so at least for a fairly significant amount of the sample, we have effective equivalence, but there are these less good matches that, again, could be semantically equivalent. There's no way of knowing that until we do more work. Right, so for the semantic equivalence problem, and as a bonus side effect, the ability to code the IRS data to a occupation code, we develop a transformer-based autocoder. So of course, you're undoubtedly familiar with ChatGPT. The T in GPT stands for transformer. This is a style of architecture that these large language models have used with obviously great success recently. So one advantage of BERT is that it's an open source large language model, so it could be used freely within Census or any other government organization. It's pre-trained on Wikipedia and the Toronto Book Corpus, so it's got a lot of built-in knowledge of how words are used and what they mean through these 3 billion words it's been trained on. And BERT in particular, it does what we want. What it's going to do is it takes an arbitrary text string, a word string in particular, and it's going to map this word string to a numerical vector that's supposed to, in some broad sense, contain semantic encoding of what this word or sentence or paragraph contains. Okay, so in particular, like for our example, it's a 128-dimensional vector, so it contains 128 dimensions of some sort of meaning. And then the goal is to use that encoding of each text entry and compare those encodings across the ACS and IRS data. So in practice, what we do is we estimate a multinomial logit that has 565 choices. This is the most disaggregated Census 2018 occupation codes. So things like lawyer versus paralegal versus doctor. Okay, so the inputs for this, in its current form, have two components. First, we take the text write-in, so if someone wrote, driver, I drive people to the store. We take that text write-in, we encode it using BERT, that drops it down to a 128-dimensional vector. We're actually going to append information from industry, because as you're aware, fairly high priority thing when predicting someone's occupation is what industry they're in. For example, the education industry has a very different occupational distribution than the manufacturing industry. So we're going to append information from the industry. Importantly, I should also say, this is available to the IRS as well. The IRS will have access through their data to both the text write-in and industry information off, say, the Form 1120. And the target is going to be just simply, how were you coded by the census in the year 2019, according to 2018 occupational codes. I didn't mention before, but the census coding process is quite involved. It has human coders, it has an auto-coder itself, and an edit process. So a lot of work goes into high-quality codes on the census side, so we're effectively taking those as ground truth for this particular exercise. Okay, and so you can see the mapping from input to output is going to allow us that anytime we actually see a text write-in, even when we no longer have the output data, we can make some predictions about what occupation code this text write-in would receive. Okay, so I'm going to show you some estimation results. So the first column is just the two separate models we estimated. In the first row of that column, this is information that's available to the census internally. This is the ACS write-in and ACS industry information. The second model is going to be one where it's simply information available to the IRS internally without any information that had to have come from census. So we're basically thinking about two different models, one the census could run internally, one the IRS could run internally, and compare them. Where in both cases, the target data is still these census occupational codes. The second column, match rate, this says what's the probability that the most likely predicted model occupation is the true occupation coded by the census. So in the first row, you see that just using census-based information, there's an 81% match rate. That is, 81% of the time, the model predicts the same occupation that the census coders predicted. In contrast, the IRS score for this is not unexpectedly quite a bit lower. 42% of the time, just taking the IRS write-in, IRS industry data, only 42% of the time can we correctly predict the census occupation code this person was coded at. I don't want to undersell this result though. Recall there are 565 categories here. So if you were just randomly throwing a dart, you would hit it with 0.2% accuracy. Okay, so this is a large improvement over any sort of existing way we could do this. But it's still, not unexpectedly, you're using different data to try to predict what the ACS occupation code is. It's quite a bit lower, and we're working kind of actively on ways to deal with this issue. One of the ways we're working on trying to deal with raising this accuracy is thinking about more general predictions. So for instance, the top two column, the third column, says, what's the probability that your top two most likely occupations predicted by the model contains your true occupation? So if it's elementary school teacher and secondary school teacher are your two predictions, what's the odds that you're in one of those two? And of course, the ACS model does quite a bit better. 90% of the time, we have a top two match. But obviously, definitionally, you're going to do better, but we do 12% better with picking up an additional 12% of matches where the IRS data didn't get it exactly right, but got it in the top two. If you extend this to top 10, you can see the rates go up to 97%, near certainty for the ACS coding, and 77% for the IRS coding. One thing this suggests to us is perhaps it's the case that these top 10 occupations at this very disaggregated level are really just slightly more aggregated versions of the census coding system. So you may be familiar with a 23 code major occupation classification. So we're currently in work looking at whether the matches at that 23 code level are significantly better than at the 565 code level, which we would expect to be true. Okay, so we're going to then use this model to look at the semantic similarity of the ACS and IRS measures. So semantic similarity measures, so semantic similarity, I mean, is going to take the predicted values of each of these models. And the values by predicted values mean these are predicted probability distributions. If I see that someone wrote in teacher, the model has some guess for how likely that is an elementary school teacher, secondary school teacher, preschool teacher, TA, all sorts of different possible jobs. So these probability distributions will be predicted by both models, and I'm simply going to compare them for each write-in. So we're going to use a measure called the total variation distance that says how much do the two predictions across all these different categories disagree. So this measure is very, very large. For instance, if the ACS write-in is coded with certainty as being a teacher, and the IRS model is coded with certainty as being a clown, to use the earlier example, right? Those are going to have really, really big total variation distance disagreement. On the other hand, if the model has to just throw up its hands for both the responses, so if the person just wrote worker in the ACS and worker in the IRS, that would still be considered the same because it has the same information content. So the results from the total variation distance, I'm not going to get into them in detail here, broadly agree with the token-based results. Okay, so about 50% of paired entries are, under some reasonable definition, I think, semantically similar. And 33% of them I would consider high quality matches, which actually is very similar to the 33% that were perfect token matches. Right, so this will, it's difficult to come up with a strict guideline for this is a good match, this is a bad match, but the hope that is we can continue to improve these matches and continue to improve the coding accuracy of the IRS data for when later we'd like to code the entire IRS distribution. I would briefly like to mention some agency benefits. So the census, sorry, I should start with the IRS. IRS agency benefits in particular, it's desirable to have this 128 million sets of write-ins coded each year, somewhere between 120 and 150 typically million each year they have to do write-ins. And this process is something that could actually just code them automatically with very little human input and at scale. Additionally, for years where it's linkable with the ACS, you can do quality control. You could check, okay, did the evolution of write-ins or evolution of occupations in the economy affect now what people are writing in and how we should code each write-in? You don't need the ACS in any given year. We can generalize this to additional years that weren't originally trained on. But for quality control purposes, anytime that there needs to be a check, it could just simply be linked with the ACS again and redone. For the census, we've been working towards, did I go backwards? No, I didn't. Sorry, excuse me. For the census, we've been working towards replacing our proprietary statistical software and computational resources with open source versions of the same thing. And I think this serves as a good example of just a purely open source, actually top to bottom, we don't use any non-open source software in this procedure, open source machine learning based occupational coding, which of course I think is a lot of active interest for how census can move forward and modernize a lot of its processes. Additionally, of course, if there are situations where we have missing occupations in the ACS, it will be nice to have additional IRS observations of those same occupations that we could potentially use to improve our imputes. And this is something we actually at Census already do on the earnings side. Another project I'm on is working on improving earnings imputes using administrative records for missing survey data. Okay, so we do a very similar thing with occupation. All right, so in conclusion, we've been able so far to create a near universe file of coded occupations just off Form 1040 data, write-ins. And the ACS data has played a pivotal role in this, I think, which shows a nice synergy across agencies to be able to do both us contribute this coding process and quality assurance, but also IRS just providing the data. The results so far have shown that there's a lot of economic content in these write-ins. So while you may not think that coding rate was incredibly high, it's certainly much higher than any other, as I said, information currently available for what people are doing. So there's a lot of economic content there. We're still working, of course, on improving that, and the hope is we can improve it substantially by using, say, different aggregations or looking over different time periods. So those are the next steps we're working on right now. And thank you for your time. I appreciate it.
Good morning. I'm Bizbadani from IRS. So my presentation is a little bit different from Amy and Carl. They are focusing more on entity resolution and data similarity. So mine is on meta-analysis on disaggregating tax compliance burden, a comparative analysis. So the overview, as you can see, my presentation outline is I start with introduction, and there are topics on concepts, methods, and challenge in tax compliance research. I continue my presentation on empirical evidences from different studies. And then the last section will be on case studies comparing US tax compliance costs with other countries, other developed countries. So what is tax compliance cost? So when we say tax compliance cost, this is the sum of the out-of-pocket costs plus the time allocated to file taxes by individuals and businesses that will be covered in this study. So the main objective of this study is to conduct a comparative examination of tax compliance costs incurred by individuals and businesses. Main data source is secondary source from published articles and administrative sources as well. I also use the World Bank data. This study examined first the conceptual underpinnings of tax compliance costs and then methodological changes in conducting these kind of researches, and then comparing and contrasting US individual and business tax compliance costs with developed countries such as the UK, Australia, Canada, and Germany. These are the main findings. I will come to all these details. So tax compliance cost studies face several challenges. For instance, non-response bias, data scarcity, questionnaire framing issues, and monetization of the compliance time. Tax compliance costs are negatively related to with firm size and income. Individual taxpayers in the US are facing higher compliance costs relative to Germany and Canada, whereas small businesses face lower cost to those of Australia and UK. So before we go to the details of this, so the first section that I reviewed is what is tax compliance costs, what are covered in the study. So when we see the cost of tax in general for society, we can consider the social cost of tax, right? So that is a cost, the total cost for society as a whole. So in the first paper, as you can see here, social cost is deadweight loss, administrative expenses, and compliance costs, right? In general, for a society, right? So when we consider the tax compliance cost, that is out-of-pocket expenditure plus the imputed value of time and other resources minus if there is any benefit from filing your taxes. Administrative cost is for collecting tax for the government. The other study from Australia shows that, the US is by Gaitan et al. 2003. So they define total burden. Total burden is the sum of tax liability and excess burden. Excess burden is divided into compliance burden, psychological, and efficiency. So the efficiency and psychological burdens are difficult to measure, right? So psychological burden is the dissatisfaction, frustration of taxpayers with interaction with tax authorities, and this is difficult to quantify. Similarly, the efficiency loss, what we call is the deadweight loss, which is the distortion created by tax and which affects the consumer and producer surplus, is also difficult to quantify. So all the studies that I'm gonna cover in this paper do not include the psychological and efficiency loss. So when we say tax compliance cost in this case is only the costs spent by taxpayers on different things, out-of-pocket payments, plus the imputed value of time. Okay, so that's what we gonna see in this. The other things that I covered in this paper is the methods. There are different methods, and there are few multi-country tax compliance studies and data. There are two that I reviewed here. One is the standard cost method, which is used in the European Union, across all the countries in the European Union, and defines compliance cost to include all expenses related to discharging their obligation to file tax. And the main advantage of this method is it is suitable for impact assessment, right? So it's possible to see the impact of tax on taxpayers and also comparing, across countries, because this method is used across the European Union. It is possible to, compare the effect of tax across these countries. And supportive segmentation facilitates comparison between countries, as I said earlier. The main drawback of this method is data does not, drawback is issue with representativeness, failure to consider temporary compliance costs, and so on. The other data that I reviewed is the World Bank data, which is collected from 189 countries about the ease of tax compliance. This data is only valuing the time, the total time, hours spent annually on tax preparation, filing, and payment. The main advantage of this provides consistency and a substantial volume of expert estimates, because the data is collected from tax experts from different countries, so we can get expert opinions about the total tax compliance. But the limitation of this data is data does not distinguish between small business, large business, medium business. So it is not possible to do this effect of tax compliance on different firms, right? So by business size. The other issue with this data is there is the methodology has faced criticism for producing unrealistically large figures in some countries, and irregularities have been documented. The third one, this is the US Internal Revenue Service data. So this data is collected for individual surveys were collected on individual taxpayers' burden and business taxpayer burden. So this data was collected starting from the 1984 and covering individuals and businesses. So the ITB survey categorized tax returns by preparation method and further stratify by level of complexities as low, medium, medium, high, and high. And the BTB also conducted with a gap. As you can see, the BTB survey is conducted with a gap. And the IRS also uses simulation models, individual tax burden model, the small business burden model, and business taxpayers burden model. And this model is a log linear specification as a function of different covariates. For instance, for individual tax burden business burden model, it controls for income, preparation method, and complexity of the tax code. So this is a log linear model that simulates the data. The advantage of this data is highly representative data and employs a robust methodology, as I said earlier, because the IRS conducts these simulations, as I said earlier. Drawbacks: IRS survey respondents' inability to differentiate the time used to prepare their federal and state tax returns. As I said earlier, there are several challenges in tax compliance research. One of the challenges is data and availability. All these studies rely on surveys, qualitative interviews, case studies, and so on. So one of the challenges is lack of panel data. So panel data is superior than cross-sectional and time series data, because panel data can control for individual and time heterogeneity. And also we can have large degrees of freedom by having a panel data. So it is possible to get a more robust result by using panel data. The other challenge in tax compliance research is survey design. There is a study from Belgian business data found that framing temporal aspects in terms of monthly versus annually change the result. So for small business, for instance, estimate could be reduced by 53% versus upward of 112%. So you can see which affects, the result of this. Non-response bias is another challenge. If there is a systematic difference between respondents and non-respondents, that affects the result of the study, right? So all these studies that I listed here recognized the challenge of non-response bias and use different techniques. For instance, Evans et al. 2013 and Tran 2014 employed a wave analysis. This analysis is dividing the respondents as early, middle, and late respondents, and conducting a chi-square test if there is a significant difference between the two groups, so that the result is robust. The other is attaching population weights and sample weights. The other challenge of conducting tax compliance study is monetization of compliance time. So there are various ways of quantifying the time, right? So we can apply the average wage rate, applying variable monetization rate, charging hourly rates of external service providers, or using evaluations reported by respondents. So one study by Contos 2012 examined using variable monetization rate ranged from $8 to $90, and the fixed monetization was $28. So the result shows that, as you can see here, because of the difference in our way of quantifying the time, 11,600 using the variable monetization rate and 10,300 using the constant monetization rate. This is the empirical evidence from different countries. As you can see here, the sample size, response rate, time burden, average cost, and so on. So the main takeaway from this is response rates vary, as you can see, from 0.5 to 60%. Time burden also varies, as you can see here. Average cost from 130 for Canada to $773, and sample size also varies. Similar for business taxpayers as well. There is a variation in sample size, as you can see from all these studies from different countries, starting from 2000 to 2017. Sample size varies from 41 to 22,000. Response rate less than 1% to 42%, and the average cost also varies. So there is variation because of various factors, and as well as the studies covers small business only, some small business and medium, some of the studies large businesses. This is the structure of cost. For instance, this data is from the European Union that firms are outsourcing. As you can see here, we have the VAT and CIT, and firms are outsourcing this activity. And the second table shows the internal, external, and non-labor costs. As you can see here, in the US case, 58.7% of the cost is for internal cost. This one is the data from the compiled from the 1040 instruction for business and individual taxpayers. As you can see here, businesses allocate 50% of the time on average on record keeping versus individuals 36%. Another study from UK and Australia found that 2/3 of the time is for record keeping, and versus for Canada and South Africa, it is almost half. So this is the time allocation for different activities. From these models, what are the very important factors that determine tax compliance cost? In this case, I reviewed income, tax code, complexity, and firm size. Income is negatively related to tax compliance cost, and tax compliance code complexity increases the cost. All these studies, as listed here, support this evidence that the complexity of the tax code increases the tax compliance cost. The other is even the choice between itemized deduction and standard deduction is influenced by the complexity of the tax code. The last one is the firm size. Firm size is negatively correlated with tax compliance cost. All these studies support that, provides evidence supporting this. This is the data from the World Bank. As you can see, the average median US firm spends 175 hours on tax compliance, higher than the OECD average, higher than UK, Australia, Canada, and Japan, but lower than the Germany. So this is in terms of the time, the total time, as I mentioned earlier, and that's how we do with, relative to other countries in terms of total time. This is a case study selecting 3 countries and comparing with the US for individual taxpayers from different studies. As you can see here, US compliance costs are shown to be lower than Australia, but higher than those of Germany and Canada. Even the recent 2023 data is $150 for US individuals households versus Canada is $130. So that is, the difference between these two. Similarly, for business taxpayers, I compared with Australia, UK, Canada, Canada and Australia. So as you can see here, US small and medium enterprise incur higher costs than Australia, but lower than the UK. In conclusion, so the main findings of these papers are tax compliance costs are determined by firm size, income, and tax codes complexity. Tax compliance studies face several challenges, as I said earlier, ranging from non-response bias, data availability, lack of panel data, and violation of compliance time, as I said earlier. So the main message here is it is very important to be cautious when we are comparing these data from different countries. Individual taxpayers in the US pay higher compliance costs relative to Canada and Germany, whereas small businesses pay lower than the UK. Thank you very much. If you have any questions, please let me know. Thank you.
I don't have slides, so I'm just going to talk. I love these conferences because you just see the exciting work that's done at the IRS and by other agencies using the IRS data and the way that agencies other agencies on the IRS work together to produce valuable new evidence. I think these papers are good examples of that. I'm going to talk about each of the papers in turn fairly briefly. Amy O'Hara had a paper on improving linkages, which, as she eventually noted, I was on the advisory committee with her, and I was reminded when I was reading the paper that she was always talking about ways that state and local governments could benefit from the new National Secure Data Service, and obviously being able to connect their own data with the IRS data would be enormously valuable. And the main goal of this project, as I understand it, is to connect state and local data with, or probably data from tribal governments as well, with IRS data and produce aggregate statistics that are useful for policymaking and are useful for citizens who are trying to figure out what their governments are doing. I always learn something from Amy's work. What I learned from this one that really stood out was that Australia has an official data corrupter. I thought that just happened organically, but it turns out that there's an official way to corrupt data in Australia. And Amy was able to figure out how to apply it to her analysis, which was messing up some synthetic data and then seeing how this, how the linkages would work after doing that. One of the things that this paper talks about is testing in terms of the number of matches under different criteria. And this is an obvious criterion for quality, but maybe one that bears some exploration, because you can imagine cases where you have fewer matches or even less good matches, but that the things we're trying to measure in some cases might be measured better using the less accurate matching algorithm. I don't know whether this would happen, but I think one thing that would be useful for this analysis would be to look at things that you would want to be displaying in these kinds of linkages. For example, now I'm thinking about the next paper, income by occupation, but the crosstabs by various characteristics, and see whether the things that you're really trying to measure, what matching algorithm works best for producing those estimates. I know that this will be one of the stages in testing, but you really need to test this using real data. And this could be done inside the IRS if some states were willing to share their data with the Internal Revenue Service for internal testing. The Sanders paper is a really impressive piece of work, pulling together occupation data from the ACS and comparing it with the occupation data in the 1040. The thing that's kind of surprising is that given that the IRS says, tell us your occupation, they don't say why they want people to tell them their occupation, and there clearly is no consequence to making something up, that actually a third of the sample, based on their match, actually had a perfect match with the data that was reported in the American Community Survey. The reweighting gets the number of occupation records about right, assuming the ACS is accurate, but it assumes that people who write in their occupation are not systematically different from those who don't in the same occupation. And that it suggests that the matched data set could be the corrected occupation codes in the IRS data could be valuable for some kinds of policy analysis. A similar comment to the one I made for Amy's paper is that I think we want to look at what we would want to measure using these occupation data, not just whether we get an accurate occupation code for a large number of tax records. So, for example, look at income by occupation and how does that vary between the tax data and the IRS. Look at other things that we might want to measure by occupation, and the paper actually mentions reasons why those data would be useful. For example, they say you want to look at occupations over time, across locations, across generations, over the course of careers. How well would the data that we're interested in, say income or other things, be measured using these corrected occupation codes? Finally, I guess I have a policy recommendation, which is that there would be a way that the IRS potentially could get better information on occupation, and that would be if they required employers to add an occupation code to the W-2 form when they fill it out. That doesn't work for people who are self-employed, but presumably employers know what their well, is that right? They might know what their employees are doing. The last paper is a literature review and a synthesis of studies over time and across countries in the United States and a number of other countries. It's an enormously valuable contribution to the literature for people who aren't immersed in the data on compliance burdens like me. I think there's a lot of valuable information there. As the paper mentions, it's a valuable resource, but it's subject to substantial limitations because of problems in data quality and just lack of information, for example, panel data that would be enormously useful for some purposes. There are some things that I found a little bit counterintuitive. For example, the compliance costs are regressive. And I guess that I would like to see a little bit more discussion about why that seems to be the case. And one explanation could be their big fixed costs, so that for low-income people, big fixed costs are a large part of their income and their tax liability. For high-income people, they'd be a smaller part. But it's not obvious that obviously the value of time is a lot higher for high-income people than it is for lower-income people. High-income people have much more complex tax returns generally than low-income people do. So just decomposing those changes would be useful to see. One thing that is not captured in any of the analyses, as far as I can tell, is uncertainty about the law. And I think that could be a significant cost, especially in the United States, for non-wage income. That is, if people don't actually know, if they have a lot of uncertainty about what their actual tax liability is, even if they don't spend a lot of time trying to measure their tax liability, that creates risk that might otherwise be avoided. And that could be related to the complexity of the tax system and to other factors. In the international comparison, I'd like to see more discussion about what drives the difference in compliance costs. The IRS has a burden model that estimates how certain factors of the tax code and tax preparation are related to tax burden. And as the author mentioned, burden is related to the complexity of the tax system. I would think that in an international comparison, the United States complexity compares pretty poorly, although some other countries have been trying to follow our model of putting more spending programs in the tax code, and that obviously makes things more complicated. But I'd be interested in knowing how important that is in driving the differences in compliance burdens across countries. The other thing is, I wonder if there's information about error rates that varies over time and across countries. It could be an indicator of compliance cost and uncertainty about the tax system. It's not clear that a higher error rate would necessarily mean that individuals are spending more on tax compliance. It could actually be the opposite, that maybe people are really lax about trying to figure out what their tax liability is, and that actually increases the error rate. But my guess is that higher error rates are correlated with tax compliance. And actually, I had one other comment, which was in Amy's paper. I don't think there's any discussion about reweighting to account for what you can match on. And it occurred to me that that Amy could talk to the authors of the second paper about their very careful effort to reweight their data to match to make in the second paper, to make the data in the ACS match up with the 1040. And using that kind of methodology, presumably you could produce the aggregate statistics that are produced from the match data. That's actually all I have to say, but thanks to all of you for all of your work. It's really impressive.
Is my mic on? It's okay. Okay, everyone. That was a really great presentation from everyone. So now we're going to take questions from the audience and also questions online. So does anyone have any questions? Just raise your hand. Okay. This gentleman right here in the black suit. Oh, they're going to bring you a microphone.
Thank you. Yeah, my first question is for Amy. I was wondering if you have considered any semantic matching for linking, just like we heard Carl talk about. That's totally different than fuzzy matching and all of that, right?
Right, because we're looking for an individual match, we want to look at the quality of those personal identifiers and probably lean toward the patient matching literature instead of the semantic matching. I think as we need to discriminate between multiple matches that you might get using those personal identifiers, some semantic matching may assist. But we want something that is going to be easy to operationalize within SOI's existing tech stack instead of something that might need like very different modeling or different compute capacity. But that is something that we could use in the future to further refine it.
Okay, this woman over here.
Hi, I have a question for Bizoyahu. From a policy perspective, do you think the tax burden literature should also include the efforts that people take to minimize their tax liability, not just being literally compliant?
Thank you. So you're saying the interest of people, you said? Can you repeat? I missed the first part of it.
Right. So this is like a very narrow kind of look just into someone filling out their tax return to be compliant. But what about all the efforts behind the scenes to minimize their tax liability on top of just being compliant?
So taxpayers are doing different things to minimize their costs, right? So one is record keeping and having good record, for instance, for businesses. So that's one of the things that is covered on those studies. There are questions about, the time allocation and so on. That will cover some of the,
And your study mentions tax planning, and I think that would
Yeah.
include the tax avoidance. And one of the things that struck me was that I think that the highest cost was in Ireland, which is kind of a tax haven, right? And I assume tax planning would be a big part of that.
Yeah, so the questions, cover all these things, yeah.
The question for Amy, and I think Lynn might have some comments as well. Is there a view, maybe you've already thought about it, but a view to accounting for non-filers and late filers? So the filing population is not static even after the filing deadline is coming on.
Thanks, Alan. There is a desire to have an MVP approach. So what would you be able to do right now without doing any system development? But in the future, what I would propose would be something like creating an index that uses the information that you would observe historically in the CDW. So you would see people that are moving in and out of filing status. And also that would be able to improve matching whenever you have name changes, potentially people moving in and out of the US. So that you've got these different representations of identity with name and address, potentially between ITINs and TINs, but none of that is really going to be observed on that client side. So I think that in the future, being able to have that information, and that would improve both the accuracy of the matches as well as the operational efficiency of making them. So that would be a future development. What would you do?
I don't have anything to add.
Thank you. Were there any more questions? Okay. This lady right here.
Hi, I have a question for Yahoo. And so based on your study, then the panel data would be recommended. So thinking about the current practice of the tax compliance burden survey, would you recommend that we do a wave study in the future, since those people who responded would be more motivated to answer our surveys? Would that be a good way to go? Yeah.
Yeah, if it is possible, if it is possible to do that, that will be great. Not every year. It's possible to collect panel data with a gap. So every 3 years or 2 years, if we have 2 and more waves, we can get a better, fit, a better result. And we can, solve the problem of omitted variable bias, which is common on these ordinary least square regressions in, linear models. So yes, there will be value added by, collecting panel data if it is possible in terms of legislation and so on.
Thank you for that. This gentleman right here in the gray shirt.
Hi, this is for Carl. I think, have you thought about, I see you using the industry codes within the IRS to look for the occupation. Have you thought about using other data in the IRS, like wage or wage history, or even like other occupations listed for that employer to do matching?
Yes, we were actually just having a conversation about this internally the other day. The general setup we're looking for is one where it's something we can produce with sort of arbitrary sets of controls there. In that, especially for researchers, if your research question is, what does your coworker's occupation do to your occupation? You don't want to have those things already built into the coding model. That's going to pre-bake everything in. But for most questions where that's not the case, that might be incredibly valuable information. I can actually sort of just vouch that isn't, having looked at the data, that's incredibly valuable information. And so the goal is basically to have multiple tracks of the same data set. And this, for releasing it, this would be a little bit more of an issue, but multiple tracks where certain researchers, if you have this interest, this one doesn't have as much information pre-baked in. Same thing, of course, wages and earnings, right? That, they're used a little bit in the census edit process already, but I would be hesitant because you don't want to, running a regression of wage onto occupation, you don't want to have things that are too biased already built in. But that's a great suggestion. And in particular, I would say that having looked at it, this coworker occupation is going to be very neat when it gets brought in.
Okay, thank you for that, Carl. Any more questions? And over here.
A question for Ms. Amy. Now, are you using identifiers like mother's maiden name and things like that? Because I learned after almost 30 years or 40 years that Social Security Administration has a wrong mother's maiden name, and rest of the other, including USCIS and maybe IRS, has a different mother. So how do you match all that? And I was told that it's very complicated to change mother's maiden name in because they need a birth certificate, and I was born in a country we didn't have in 1942 birth certificate. So I don't know what the procedure is. Finally, I gave up and found out what actual, in those days when we came as a student, the chairman's secretary got our social security number. They filled out whatever form, and I have no knowledge what they filled out.
So right now, we're looking at most clients only providing name and address, SSN if they have it, and we're already skeptical about the completeness and validity of that. So we're starting out with like a natural skepticism, but in the index that I was referring to when I answered Alan's question, that's where that additional information would come in. And it too would need to be either validated or vetted to its accuracy, but it could be a contributing factor. And this is similar to the individuals that you appear with on a tax return, thinking of them more as known associates rather than using that to infer family relationship. But it would be taking this information more broadly and using certain identifiers with certainty, and then using that additional information, even if it is flawed, that would contribute to the discriminatory power of coming up with the right match. But the fundamental matching occurring within the federal statistical system relies on the SSA numident kind of as the backbone. So any noise in that is ported into the matches.
Okay, thank you for that, Amy. Any other questions? This man over here.
I have a question for Mr. Bourdain. In the papers you reviewed, the units of the tax compliance burden, are they all in per person or per firm or per tax dollar filed? It seems the inverse relationship is more obvious if the unit is all about tax dollar per dollar filed.
Yeah, so the units, all the units from other countries are converted to US dollar. But the best way to go may be finding a percentage for comparison. That will be the best way to go. But that's because of lack of data that I cannot find, the percentage and include that. But all the values are in terms of US dollars.
Okay, thank you for that, Biz. Question right here.
Yeah, for Biz, just were any of the countries that you looked at using or augmenting their surveys with data from software providers? I think TurboTax knows pretty much everything about how long it takes me to do my tax return, how many sessions, how long I spend on each screen and each component. And I'm just wondering if anybody has found a way to leverage any of that information to augment the survey. It might be a way of thinking about getting that panel component, for example, since I use the same software every year.
You said the 1040 instruction data?
No, using data from third-party software providers like TurboTax or H&R Block or one of the electronic filing services where many of us fill out our tax return every single year. They're collecting a large amount of administrative data on my essentially on my burden on how I'm interacting with their software. And I would think that aggregates from that could be very useful for measuring some aspects of burden. And also maybe getting that panel aspect of it as well.
Yeah, but these studies are conducted, sent questionnaires separately about the time that it takes and the money and so on. Those informations are not included in those softwares. But yes, some of the information can be used from those databases, but some of the specific key component of the questionnaire we cannot get those information from TurboTax or other information. But some of the information may be available, but these questionnaires are specifically targeting tax compliance burden and asking the time, the money, and the planning, and so on. So all those are key information probably missed from those databases, but it will definitely support to conduct tax compliance burden research by using all this database.
Okay, any more questions?
Can I answer?
Oh, right here.
Yeah, this question's for Amy. Have you looked into using GIS software specifically for the address matching? Geocoding is a pretty strong tool for even incomplete addresses, and many state and local governments have their own GIS programs, which this type of data could interact with pretty easily, I think. So.
Yeah, that is a future research thing. Right now, we're still trying to get a handle on the degree to which these state and local governments have captured that information and whether they have a date stamp with it. And how they are maintaining that information. So for us, it's really an information quality issue first, and then in the future we can get to that. However, when you look at the way that the health IT world does data matching, a lot of the times they are less reliant on that. Right now they're using cell phone numbers. So it's figuring out what are the relevant identifiers, the relevant complete and available identifiers. But that is definitely something on our radar, and we're going to think about how we're going to do that to improve the blocking The base approach that I presented was on zip 5, zip 3, but that, of course, can evolve over time.
Okay, thank you for that. Are there any more questions? Okay, so at this time, I'll read some questions from the people watching our live stream. So this first question is for Amy. Is this demographic information being used to support community reinvestment actions?
So for the SQS, when a client brings information, they will need to demonstrate that they are an eligible organization, so they're a not-for-profit. And they are going to need to validate their information that it is going to be able to flow through the automated process. When they get their page of statistics back, and it is a page of statistics, what they do with it is going to be up to them. Initially, we are going to say, hey, is this a valuable program? What are you using this for? But there are not going to be strings attached about how you are going to get this information. If you are eligible to get it, whether you're using that to evaluate policy, monitor trends over time, that's kind of something that is being left to those organizations. However, we do anticipate that they will use it for things like that. There are going to be a lot of policy relevant, that's why it's tied to the evidence building work.
Okay, thank you for that. This next question is for Biz. How do the USA's tax compliance results compare with countries that have a similar response rate during data collection? All the countries shown have a lower response rate than the US.
Yeah, that's true. So one of the strengths of US tax compliance research data is the response rate is high and highly representative data. And that's the limitations that I mentioned earlier. When we compare, different studies, we have to consider this, the response rate, the representativeness of the data, and so on. So the US is a gold standard, which is using large data set and robust methodology relative to the others. But I am comparing with developed countries like Germany, Canada, Australia, and so on. So those are, countries with a better data and better model. So.
Okay, thank you for that. Before we wrap up, are there any other questions from the audience? Okay, well, thank you all. I appreciate you taking the time.
Do we have our next moderator, Debbie, here? If everyone could please be patient, one moment.
I know. Just show me. I don't have to do anything. But for the which advance is it? Advances.
Green button advances. If you need to go back, it's that red one. Yep.
How are you? Yeah, it is, and I suspect it's not tomorrow.
So, we want you to go ahead and start turn,
Hello. Can everyone take their seats? We'll get started in a minute. Okay, we'll get started. Hello, I'm Debbie McKelko from IRS, Research Applied Analytics and Statistics. We're moving into our second session, which will be on discovering the art of avoidance. The first presentation will be on using a gravity model to predict cross-border tax avoidance, presented by Michael Udell from IRS, Research, Applied Analytics and Statistics. The second will be on Art in the Age of Tax Avoidance, presented by Matthew Pearson, the Wharton School, University of Pennsylvania. The third will be staying on the wagon, estimating indirect deterrence effects from filing and payment compliance programs, presented by Brett Collins from IRS, Research Applied Analytics and Statistics. Our discussant will be William Boning from U.S. Department of the Treasury. I'll welcome up now Michael Udell.
Thanks, Debbie. So this is work that is joint with Lori Stuntz. We've been working on a model for a number of years now. It's a work in progress. And let me start with, what are we trying to do here? So the ask was, is there a way to see tax avoidance in the current period of time? It's 2024. What can we tell about tax avoidance, cross-border international tax avoidance today, not from 2017 or 2016, but today? So that ask really restricted the kinds of data that we're able to look at. We need to look at data that is current for today and build a model from that, right? So what is tax avoidance? It's not tax evasion. Tax avoidance is simply the relocation of a taxable income flow from, in this case, we think of it as a source country, to another country where there's less tax. All right, tax avoidance happens all the time, and as you all know in this room, it's legal in general. Tax evasion is a different flavor of tax avoidance, and we can't estimate tax evasion in this model because that's a legal determination. So this is a model about tax avoidance, but it sort of points to places where there might be tax evasion, right? How large is cross-border tax avoidance? Well, it's large. We have lots of estimates. The first two papers here, Beard, Demoij, and Liu, say that a 1% change in the domestic corporate tax rate results in a 1.5% reduction in reported corporate profits. So those profits went somewhere. They were shifted around. Lejour estimates, using a different approach, he comes up with corporate tax revenue losses to the home country, the source country, between 123 and 180 billion over a decade. On the individual side, the recent paper, Johansson, Reck, Risch, Slemrod, Guyton, and Langeteeg, a lot of IRS folks in there, that perhaps as much as $2 trillion of wealth is sitting, of household wealth, U.S. household wealth, is sitting in tax countries. So this is a big problem, at least the way what we can measure it right now. So what I'm going to do in this talk, it's going to go very fast, talk about a gravity model and why a gravity model. I'm going to talk a little bit about data, but not much. We're going to talk about what we do with the gravity model, which is we create an index. And it's an index of tax avoidance for a person who is motivated to do tax avoidance. And then we're going to talk a little bit about weighting the model if we have time. Great. So what's a gravity model? So we're familiar, hopefully, with Newton's gravity equation. That's on the left-hand side here. I can't see it very well, but that's, person sitting under the tree and the apple hits his head, and wham, there's the gravity equation. And a gravity equation, for our purposes, is really a very simple thing. It's just a measure of forces of attraction that can be attenuated by some kind of force of friction. In Newton's case, the forces of attraction were between two masses, and so he uses mass in his equation. And the force of attenuation is distance, it's linear distance. And the familiar Newtonian gravity equation is you have two masses, you have the size of the masses in the numerator, there's a coefficient. The equation says that better be 1, or we're all flying off of the planet. And then what attenuates that force of attraction? And that's what sits in the denominator, and it's distance squared. and then there's a gravitational constant. And that turns out to work really well. Fast forward to 1962, Jan Tinbergen takes this model and says, I'm going to apply it to bilateral trade between two countries. I'm going to replace mass with GDP. And I'm going to keep distance, because economists love linear distance. Linear distance is transportation costs. He fits that model, and lo and behold, it works really well. And it actually gives coefficients very similar to Newton's. That is, the betas in the numerator, they're 1 or very close. And the beta in the denominator for distance, it's 2. It's distance squared. So one of the first things we did in our group is we tested that equation using a data set put out by a French think tank, CEPII, that is called the Gravity Database. And it's a database of global trade and distance measures, and it's just set up so that you can run gravity equations. So we ran gravity equations for 2017 through 2020, and lo and behold, the coefficients in the numerator on GDP of the two countries, pretty close to 1. Coefficient on distance, pretty close to 2. About 31,000 bilateral trade pairs in that data set. So this is a well-known equation, and the joke was in 1962 when it came out, and for a very long time, that this was an equation in search of a theory in economics, because we didn't have a theory that predicted that the coefficient on distance would be 2 and the coefficient on GDP would be 1. And so there are some papers now that say, well, no, there's a theoretical basis for that. Great. Okay. So we're going to develop a gravity model, and what we want it to do is tell us the attractiveness of moving funds from a source country to a destination country if your motivation is tax avoidance, all right? The ideal independent variable would be something like a measure of tax avoidance, and of course we don't have that. We're actually going to try to back into it. Our current dependent variable turns out to be foreign direct investment, and we may not have much time to talk about it, but it turns out to be a pretty good variable. And then we're going to use explanatory variables, and this is what's different in this model. This is the contribution. We're going to specify the gravity equation only using tax administration parameters, because what we want to know is how sensitive are cross-border flows to the rules of tax administration. What are those rules? Tax treaties, domestic country tax rates, and exchange of information, transparency between two countries. Those are the key kinds of information. Two things come out of this. One, we're not limited in this model to just a bilateral trade. We can construct sequences of countries that a flow of a legal taxable income starts from, and we can construct this across any number of borders, just depending on how much computing power we have, all right? So that's actually a pretty good contribution, and it turns out that the path that money flows through is very path dependent. It's, if you go from country A to B to C to D, gravity equation is going to give you an index, but if you go from A to C to D to B, it's totally different ranking of the attractiveness of that path for tax avoidance. So that's one of the contributions here. And I think that's at the bottom here, okay? Great. So one of the other things that comes out of this, which is not in the international trade literature, is we're going to look at multiple country border crossings. And that means we have countries in the middle of a sequence, and those countries are called conduits. There's a lot of literature in tax evasion about the role of conduit countries. Offshore financial centers are conduit countries. Money comes in from a source country and it goes out to some other country. We're also going to talk about destinations. Destinations are where you want the money to land, all right? And one of the most important things about a destination country is it doesn't have tax on, it doesn't tax the thing that's being moved to it. It's safe. It's important that a destination country be safe because you always want to be able to get your money out, all right? Great. We're going to skip this slide. And then, so here's our basic gravity equation. So this deck is longer than what I'm going to present. There are a lot of slides in here that detail the calculations that we're doing in it, and so I'm glad if people want to take a look at them, love some feedback on it, because the calculations get very long. So remember, in Newton's model, there are two terms in the numerator that are describing attraction. Well, here we have two terms. The first term, which is just got this long name, dividend-owned path, basically is cobbling together the tax treaty rates, the withholding tax rates on particular sources of income, moving across any number of borders, all right? The second term, 1 minus capital gains ratio, it's all explained in the deck, is basically the difference between the capital gains tax in your source country and the capital gains tax in your destination country, because you want them to go in a direction. You want the capital gains tax to be, you want the capital gains tax in your destination country to be lower than the capital gains tax in your source country. 72 countries around the globe do not tax capital gains for non-residents. Turns out to be relevant in the gravity equation. So the denominator is specifying these sources of friction. And this gets rather involved, but the second term, 1 minus EOI, EOI stands for exchange of information. So we have all these exchange of information agreements. Say with the US, we have FATCA, we have separate automatic exchange of information, we have separate exchange of information upon request, we have KYC, know your customer rules, those are treaties with the Treasury. So what we do in our model is we just bundle these up and we map those agreements across the globe. And it's a little bit surprising. You might think, for example, that every FATCA country has an automatic exchange of information agreement, and that's not true. Some only have an exchange of information upon request for non-FATCA issues, right? KYC, very similar thing. So this is going to be tax transparency. Tax transparency with the source country tax administrator is our measure of distance. The more tax transparency with the source country there is for a sequence of border crossings, the more transparent and essentially the greater the distance. That's the friction that reduces the attractiveness in the numerator of having low rates. Because if you have a tax avoidance motive, it would be great to lose tax transparency with your source country. And that's why I say this sort of hints at where evasion might be good to do, because we can see how tax transparency abates across border crossings with respect to the US, okay? We can do this for any country. The US doesn't have to be the origin country. CRS, the Common Reporting Standard, lots of other countries have that. Lots of other countries have exchange of information agreements. So the US does not have to be the source country here, although they were the topic. The final variable, regulator quality path, that's a World Bank index. It is not a tax administration variable, but it's trying to get at the idea that there's a risk to moving money across borders. And you don't want to be moving your money across borders where you're increasingly taking on risk that you might not be able to get it. And so we've looked at a bunch of World Bank index measures. We settled on regulator quality. It has a role. It has a role in a lot of papers, right? So not going to try to discuss that. That's what the equation is going to do, right? And then in traditional gravity equation models, we log transform it. So in a perfect world, it would be the log of tax avoidance, and it equals the logs of all the terms, all right? We don't have tax avoidance, so we do something different. We use foreign direct investment, and what we're going to do here is we're going to reverse the flow. So we think about the gravity equation as moving taxable money from an origin country across conduits to a destination. There's a reverse flow that actually sets up the outbound flow from the origin country. That reverse flow is foreign direct investment, okay? Foreign direct investment from the destination country into the conduit country, then into the US, the origin country, creates a reverse flow of income. And that reverse flow is dividends, interest, royalty, income, all things addressed in tax treaties. So what we did as a first proof of concept is we said, okay, we'll use foreign direct investment and we'll use it in the reverse direction, and we'll do some little calculations on it, but that's what we did. And so that's how we've calculated the model so far. That will change in the future. Right. Quickly about the data. We use data from, it's a Dutch nonprofit, IBFD, collects tax treaty information on 230 countries. Really great. Here's the first sort of count. A lot of tax treaties. Not every country has one, but US has like 65 or 70 tax treaties. They'll often have, just for dividends, 4 different withholding rates: 0%, 5%, 10%, default 30%. So if we just look at, this is for the US, I think. No, this is bilateral. So if we just look at 2 country pairs, and we just look at the number of withholding tax rates for dividends across border, that's 59,143 withholding rates in cross-border, right? So these are going to turn out to be the building blocks of the gravity equation. Regulator quality, this is just the far right-hand side is the count. We had only 209 countries for regulator quality, so we have 230 countries with tax treaty information, so we have to sort of fill in some data here. And then, again, FATCA, EOIR, AEOI, and KYC, these are the variables we're going to mash together to describe transparency. And then I'm going to blow through this, and I'm going to get to this one slide. I think I'm going to do fine. This is how we're actually going to cobble together the cross-border tax treaty rates. This is basically a topographic mapping of tax treaties. Country A is a source country, and look, it has 3 withholding tax rates: 0%, 5%, and 30%. And it has a requirement on each of those withholding rates. The 0% withholding tax rate, that only applies to an outbound dividend where the foreign company in B owns 80% of the company in A. Let's let that sink in, all right? The 5% withholding tax rate, you only have a 10% requirement of ownership, and the 30% withholding rate is a 0% ownership. So we have these different withholding tax rates, and that's the relation. So country A has 3 different withholding tax rates with country B. And now let's look at country C. Country B has 2 withholding rates for country C. It has a 0% withholding rate, but only a 25% ownership requirement, or a 5% withholding rate for a 10% ownership. Actually, it should be less than that, all right? So you can very quickly see that for 3 countries, this can explode into lots of different withholding tax rates across borders. All right. This is a slide that we're not going to go over, but I do want to say one thing about it because it was something that popped up. Tax treaties generally give the best withholding tax rates to the trading partners of the country. The US has 12 tax treaties where it gives a 0% withholding rate on an outbound dividend. They are, for the most part, our best trading partners. But they have a very high ownership threshold, 80%, except for Japan, which is 50%. So one of the things that happens if you cobble together a path of countries is an investor in the destination country can tap into a 0% withholding tax rate in the US at a very small investment amount. And that's because, and that's what this table will show, so I want you to look at it later on, is essentially multiple cross-border paths defeat the tax treaty arrangement, or they actually empower our best trading partners to be bundlers of inward foreign direct investment to the US. And that's exactly what happens in the foreign direct investment data. The most FDI coming into the country turns out to come from our US tax treaty partners who have the 0% withholding rates on the outbound dividends. That's kind of interesting. Okay, go through this. I wanted to show this slide. I know I have a minute or 2 left. It's the only slide where I can show country data, okay? And don't let your eyes glaze over. This is a table of regulator quality indexes from the World Bank, and the variables, the countries that are shaded mean we don't have a regulator quality index from the World Bank, and so we imputed them. And these countries turn out to be themselves very interesting because they're largely overseas territories of other countries, right? But I just wanted to show you that we have lots, it's country data, and this is the 3-digit ISO codes, okay? More detail on how we calculate, the variables. Now I want to go back once. We started out in the all column with approximately 15 million pairs of 3 countries, okay? That's about how large 3 countries are. And then we whittle that down to what we call best. Because we're using foreign direct investment, we really can't determine whether the investment ownership is 80% or 10%. So we just take the best withholding tax rate. That cuts out a lot of paths, all right? And then we say every country in the sequence has to have it foreign direct investment. So we can't have a country in a sequence where there's no foreign direct investment with the next country in the sequence, because we don't have FDI connecting then to the origin. So after we do that, we end up with 670,000 3-country pairs with complete data, all right? And this is our last slide, so give me a minute. Basically what this says is a gravity equation fitted to foreign direct investment over 3-country sequences explains about 22.5% of the variation in foreign direct investment. And all these variables turn out to have the right sign. If the dividend ownership path goes towards 0%, that increases foreign direct investment. If the difference in the capital gains rate between the origin country and the source country is, well, we flip the signs. It's not, it's positive. That is, the destination country is 0. That also increases foreign direct investment. Regulator quality always seems to matter, so stability counts for foreign direct investment. And FATCA, which is our proxy for all these different tax transparency issues, the more agreements there are across each sequence, the less foreign direct investment there is. And this is 22.5%. That's pretty good R squared for a variable that does not have any mass. There's no GDP in this, and it doesn't have any distance. All right, it doesn't have any distance because we're moving financial flows. So that's where we are. We have lots of variations on this, but I want to stop right there. Thanks.
Bit taller there. Oh, I wasn't controlling that. Hi, I'm Matt Pearson. I'm at Words at the Wharton School, University of Pennsylvania, longest affiliation ever. I'm here to present Art in the Age of Tax Avoidance. I actually thought about changing the title of this, and then I saw that the whole session is structured around a pun on the name, and I couldn't. So it is what it is, I guess. Let's get into it. All right, so tax avoidance evasion. Thanks, Mike, for doing the whole avoidance evasion talk for me in semantics. So that's great. In terms of, let's call it evasion on this slide, it'll be avoidance throughout the paper. We kind of know a good deal about when it comes to specific financial flows, what paper you just saw, in terms of other research as well, in the US and across global flows. It's about 8% of assets worldwide. That's a rough estimate. Obviously, estimates can be up or down. What's notable about a lot of these, though, is that the US kind of doesn't use offshore tax havens, particularly compared to most other high-income or developed countries. Let's get into why. Is the US special? We're just great at this. There's a general hypothesis that no, we're not special. I mean, maybe we're special in other ways. But that there are enough tax avoidance opportunities domestically to make up for this gap. There's no need to move your money offshore or create a lot of these different complex structures. You can just do it onshore in much more simple ways. So what I'm going to look at is a couple different sets of research have looked at nonprofits and tax deductibility of donations to nonprofits as a tax avoidance vehicle. The problem here is that while charitable donations in the US are often more sensitive than other developed countries to income tax changes, they're charities by definition. Most of donations to charities are for charitable purposes. So how do we disentangle this? There we are. So I need essentially an asset that's donated to charities. It needs to have a legitimate use, often given to charities for a legitimate purpose. It also needs to be associated with an illicit or a tax avoidance use. What that is going to be, as you can see from the title, is art. It's a historically opaque market. It's often used for illicit purposes. This is just 3 random citations. There are plenty of examples here. I also took this graph from the Simone paper, focusing on the Swiss free ports. And it's often seen within the academic literature as sort of tax evasion spillover when it comes to wealth taxes, when it comes to displacement from FATCA, et cetera. So what am I going to do? First, I'll show you what nonprofits that accept our donations are like. This is kind of a first foray into this area. I'm going to show you that disclosing whether you have art at all for a nonprofit from your 990 filings, whether you revalue it, whether you value it at all, are all a function of audit risk, essentially. There is essentially an implicit selection issue here. This ties into this sort of classic tax evasion models in the literature all the way back to the 70s with Allingham and Sandmo, threw in a Clavin 2011 citation about third-party reporting here. Finally, this audit risk is going to reveal tax-motivated behavior. I'm going to use that to sort of tease out potential tax losses. This is going to tie into a literature on the value of audits. Will's going to discuss that later. And also tax losses to non-financial assets as well. There's 2 or 3 papers circling around about real estate and using that as a way to avoid taxes as well. All right, so nonprofits, art. I'm going to build a sample of all the e-filed nonprofit filing orgs. This is only Form 990s, not any of the extra EZs, Ts, Ns, PFs. It's going to be a total of about 5.3 million organization years. I'm going to start the sample in 2011 because adoption was much more sparse to 2009, 2010. In the sample in tax year 2022, obviously 2023 is not complete. So nonprofits, they hold about 12.4 trillion in assets in 2022. This, if you ranked the 50 largest industries in the US, this makes them the 3rd largest industry. Obviously, there's a lot of heterogeneity there. There's a lot of variation. It's not really an industry, but just to give you a sense of size. Only about 1.2% of nonprofits hold art or disclose that they hold art, I should say. And only about 17% of this, or 0.2% total, actually disclose the value of that art. They just, most of them check the box for Schedule D, Schedule M. They don't fill any sort of values. They let it go. They're allowed to do this according to audit standards, but that's just how it goes. Despite this, holdings are still pretty large. It's about $6 billion worth of art held by these nonprofits, and that's just the valued portion. There's obviously 1.2% versus 0.2. And donations on average each year of about 300 million. So let me actually just show you a little simple graph here of this. Red line is going to be just art assets, nominal dollars. Green is just basically accumulating donations. and that's important a little bit later in terms of revaluation. And then art donations is your dotted dashed line. It's, this is in the right-hand side axis. It's roughly around 300 million, peak of like 500 million, 2015. So pretty sizable in terms of donations. But you might be thinking, oh, there's tons of donations of like, I don't know, a Basquiat, a Picasso, something really, really large in value. Actually, no, there's just a lot of donations of little tiny pieces of art. This is in terms of total number of donations. The purple line, it's peaks of 1.5 million pieces individually. The average donation value is about between $2,000 and $500. So when I get into overvaluation, this isn't going to be, you know, somebody donated some Picasso for 300 million, but they said it was worth 350. This is going to be, I don't know, I found a picture from my grandma's attic. I said it's an Ansel Adams photo. It's a couple $100 more than it actually is worth. I'll get into comparative statistics. I see this did not translate very well. The perils of latex. So basically, I'm going to look at those that disclose art filings on the left-hand, we'll call it column. And the right-hand column is those that don't. Look at differences. There's not a lot here that's surprising. You know, educational institutions, they're just kind of a messy and catch-all industry term for me here. Museums are going to have a lot of art that's pretty self-explanatory. Libraries kind of do a little bit more, but the magnitudes are not large. I also use a Charity Navigator as a nonprofit that rates charities by their quality. Generally, overall, the thing to take away here is that nonprofits that accept art are large, they have a lot of salary, they have a lot of revenue and employees. They're normally rated by Charity Navigator, and they're normally rated well. Despite all this, the other thing to take away is that they undertake behavior often in the prior year that has been said to trigger an audit. I don't have exact audit information, unfortunately, but most of the legal community kind of agrees that this is the sort of way to get your nonprofit flagged. So, getting into that, similar for value. Let me move away from these awful columns. It's similar for overvaluation. So I just showed you, let me go back a little bit. Overvaluation is a little bit different, but again, audit flags are important. It's also relatively important in those that are operated foreignly, overseas. The definition here is basically your mailing address is not in the US. There could be a lot of reasons for that, but that's what I got. So overvaluation. I have this nice fancy equation. Let me explain it in words a little bit better. It's actually pretty simple. Whatever art you have on the books at the start of the sample for an individual nonprofit, take that, accumulate your art donations until the end of the sample. Obviously net of sales, that's in the 990 as well. And then subtract from that the actual assets you state at the end of the year, the book value of assets. And if this number is greater than 0, basically it's showing that the actual revenue you're recognizing and presumably the donations that are recorded on individual 1040s are larger than actually what the nonprofit is valuing the art at. I've had some feedback on this about why, and the main interesting standpoint is what we get into next, theoretically. There we are, is audit risk. Why would a nonprofit mark down the value of their donations? Because they know it's not correct. So an audit flag is about 2% more likely to report that you have art at all in the prior tax year, I should say. You're about 3% more likely to just actually provide a value, and you're about 4.5% more likely, conditional on each step, more likely to revalue, to adjust the value. Instrumenting on the prior tax years, the prior to the audit flags tax years. Tax rates, unconditional for all nonprofits. That's about 9.3%. It's negative 18%, which, like I said, is not, it's not surprising because the ability to value art is an accounting choice. It's not necessarily an avoidance choice. And then about 36% more likely to revalue the art. Under some incredibly strong assumptions, I wouldn't, hold myself to any of these, but you can think of this as basically 36% of art donated to nonprofits in value terms is overvalued, at least in some extent. How do we make sense of this? So I have a little note for an Allingham Samuel refresher, but basically evasion is going to be reduced, disclosure increases as audit probability increases. It's just most canonical models say this. The costs have decreased, we'll call it evasion or avoidance, thanks, is a mechanical increase in compliance costs. How do you revalue the art? You hire lawyers, you hire accountants, you actually more accurately value your filings. Keeping audit probability constant is another way that you might combat this, by trying to decrease your probability in other ways. In this case, you're much more likely, provided you're below the threshold where you have a choice about e-filing versus paper filing, you're much more likely to paper file, conditional on an audit flag in the prior year. So in that case, you're delaying the actual process. Not super tied to that result because it doesn't make a whole lot of sense. It's not like you're not reporting the IRS at all, but I don't know. All right, so I've been talking a lot about audit flags. What is an audit flag? All right, it's going to be that you undertook any one of these about 8 different behaviors. And then there's 2 or 3 different law firms and advisory firms that have all said that this sort of collection of things will typically flag an audit for a nonprofit. This is a diversion of assets, it's political activity, unrelated business income, that makes a lot of sense, excess benefit transactions, loans to disqualified persons, excess compensation. In this case, it'll be basically you're in the 99th percentile of compensation for all nonprofits per individual. So you're paying them your way out there on a tail. Foreign grant activity, and then fundraising, income, and expense discrepancies. This is basically you're having a fundraising event and you make no money, but you have a whole lot of expenses, or vice versa, you make a ton of money and you have 0 expenses, that sort of thing. Having a lot of trouble with this. All right, so basic panel regression. It's going to use our use and donation value fixed effects. I didn't talk much about those, but there is some information about what the nonprofit says they'll be using the art for and how they arrived at the donation valuation method. I'll include those. I'll use year-based fixed effects. Each subsequent column is conditional on the prior. So over the entirety of the sample, an audit flag is just more likely, about 1.8%, more likely to have a firm disclose filing in the next, a nonprofit in the next tax year. Conditional on disclosing, you're more likely to value. Conditional on valuing, you're more likely to alter the value, to disclose that it was overvalued and bring the value down. This is true again in the IB results that I disclosed earlier. These columns are a mess, unfortunately. And then moving on. So as evasion increases, audit probability decreases. The cost of evasion increase. I'll just skip this. It's pretty simple. It's going to be exactly what I just said. And move on to actually avoidance. So estimating and extrapolating the audit flag rate for those that actually disclose art. You can get up to, let's say, $28 billion in tax losses over the entirety of the sample over a 10-year period. That's under some strong assumptions. It's basically assuming that everyone who's filing art and then therefore not being flagged but could be flagged has art as well. These are some very strong assumptions. So this is just a top biggest estimate you can get number. It's still quite large. This is in 2022 dollars as well, real terms. under better assumptions, under specific assumptions, throughout the sample, about 4.8 billion of art is overvalued. And so in this sense, what am I saying, or there are tax losses from it. In this sense, what am I saying? So I'm gonna take the, I'll skip that part. I didn't discuss it, I'll just discuss it here. So I'm gonna take the weighted average tax rate from SOI data of donors based on their AGI, of people who donate art to nonprofits. That's in SOI data, very deep in there. Make that weighted average tax rate, assume 100% deductibility transfers through. I don't think that's a terrible assumption considering donations are small but frequent. Use that as a sort of tax loss estimate. So there's a extremely large write-down value. Think of this as almost the integral of the cumulative over the actual asset value. Yeah, you can generate an estimated tax loss from that. All right, so to conclude, about 1.2% of all Form 980 filing orgs accept art, or disclosing, I should say. The assets are extensive for art, but they are not consistently reported. They're pretty poorly reported, to be honest. There's a lot of variation by organization, by stated use of the art, by donation valuation types, which I didn't get into deeply. An increase in audit probability, which I proxy with an audit flag variable. It leads to an increase in disclosure. It increases to an increase, leads to an increase in valuation and valuation accuracy. You can use an IV to use audit rates, using prior audit rates. To confirm this, there's a mechanical increase in compliance costs and response. And then often you can use paper filings to try to push down audit probability and response as well. Overall, there's estimated tax losses of about, we'll call it 400 million a year in 2022 dollars. Thanks.
Okay. Hi, I'm Brett Collins. I'm with an economist with IRS Research, Applied Analytics, and Statistics, and I'm here to talk about a paper I did with my colleagues in RAS, Staying on the Wagon, Estimating Indirect Deterrence Effects from Filing and Payment Compliance Programs. And what do we mean by staying on the wagon? We just mean taxpayers filed and pay on time, and they continue to do that. The wagon is compliance, I guess. So why are we doing this? There's been a lot of studies on indirect effects, a lot, especially on audits. But we saw, I'm sure you're all familiar, there's been a lot of budget issues with the IRS recently, particularly in the teens, 2010, 2020 timeframe. Enforcement budget has gone down, and the various programs, treatments, I'll say, that IRS has to address noncompliance issues have really shrunk over that period of time. And then different programs have experienced different timings of that. Some have ratcheted down before others, and then some came back up again. So we see this as an opportunity, as like kind of a natural experiment we can exploit to try to better identify the indirect effects of these compliance programs. So I think I have, so just before I go on, a lot of us are probably familiar, but by direct effect, we mean we do a treatment and then that taxpayer who is treated changes their behavior. And by an indirect effect, it's a taxpayer who is not treated changes their behavior. And we can think of various channels this is propagated. Your friend received a letter from IRS and told you about it, so now that's on your mind and you change your reaction, et cetera. Social networks. And that's something we try to incorporate into a model, which I'll get to a little bit momentarily here. There's been a lot of studies in this area, like I said. A lot of them have focused on specific programs. A few examples up here, automated substitute for return, federal tax lien notices, and they've generally shown substantial indirect effects, statistically significant, sometimes and often larger than the direct effect, actually. Right, but they've generally been focused on the non-compliant population. And so that's one thing we're trying to add here. We're trying to broaden to look at the compliant population, the wagon, remember? So that's a much bigger group of people. We have a pretty high voluntary compliance rate. So, we don't want to miss those effects. And again, why do we care about this? So, these budget pressures are starting to be alleviated, right, with the Inflation Reduction Act and so forth. And so IRS is having to make decisions about where to allocate these new resources to, get the best bang for our buck, help the most taxpayers, help them avoid the compliance issues as much as possible. So that's why we want to, capture these indirect effects now. This is just to prove that I wasn't lying about the budget going down. This is the enforcement budget in constant 2021 dollars. You can see the period of our study I mentioned, it's about 2010, 2019 range. We don't want to push into the COVID years. That kind of messes things up. And over this time, it's about a 20% decrease. And then also another example of some trends over this time, I have in these dotted lines, the orange and red, those are sort of the size of the problem, you might say. Red would be unpaid assessments or taxpayers that have an outstanding balance due, they're in delinquency. And then the orange would be non-filers. So that's our, with 2010 being the base year, this is like an indexed value, right? So you can see the problem, those two lines are kind of going up, right? Things are getting worse over this period. And then the three treatments are the solid lines. Those are some notices, ACS notices, CP59 notices, and then field collection. And we're focusing on those three here in our study as treatments. For one, just for simplicity, there's a lot of things IRS does, but we wanted to just highlight a few to make it more digestible. We wanted to cover some campus programs, which are handled by CP59 ACS. Those are letters that go out, it's not like a face-to-face interaction. And we wanted some representation for field. So that's field collection where someone's actually knocking on your door. And obviously that's more resource intensive. And you can see, following the decline in the budget, these programs are generally trending down over this time period, but the shocks are not identical, and we even see some increase in CP59, towards the end of the year. So we're hoping that helps us to kind of identify because of the differing shocks, right? So what is our data? We took a sample of, a repeated cross-sectional sample of 1% of compliant taxpayers, compliant meaning fully paid and filed on time. We have tons of data, right, for IRS. There's a lot of these, so we end up with millions of records. And we also were curious for taxpayers who did end up falling off the wagon. They were compliant 1 year and then failed to file and pay on time the next. We want to know, well, even if you maybe had a new balance due, maybe you owe less than you otherwise would have because of these indirect effects. So we had to kind of oversample for them too. So I just wanted to mention that here. So what are the models we're using for this? So we did a two-stage model. It's a fairly straightforward kind of multinomial where we're looking at just your probability of compliance. And we set it up where we have filing and payment separate. And then we have a two-stage. We do an IV in the first stage to account for potential indigeneity issues. We do like a zip code level model. So, we don't want it to be the case that enforcement changes based on compliance changing, right? So we have to kind of account for that with the IV. And then we just did a linear model for the dollar change part for those that end up failing to pay on time. And we'll get into a little bit more details about these here. This is kind of a sneak preview of the results. I'm jumping the gun a little bit. Again, for the context in these years, you can see we had, over this time period, it's about 149 million returns filed, and most of them are compliant, 125 million. And so the people that tend to fall off the wagon, it's about 5% total. 2% are just late filers, and then 3% end up owing an outstanding debt that they didn't fully pay off. And then again, the sneak preview part is we've found the biggest impact from the ACS letters, which are letters sent to taxpayers that, didn't do everything we think they should have done. And CP59, which are sent to non-filers, we have the information return, but we don't have the actual 1040 from them. And then we saw significant effects from the field contacts, but much smaller magnitude. All right, so I want to talk a bit more about the social connectedness measure. So I mentioned, the way that these things can flow is through your social networks. So we wanted to kind of incorporate it in the model. So we used this work by Bailey et al., economists who use these Facebook linkage measures between zip code pairs. So every zip code you can measure, it's a way of measuring the social links that occur between those zip codes. And we wanted to incorporate that in the model. And so, it's basically just taking advantage of their work, building this weighted index that it effectively creates like a intensity measure, for each of our treatments within a zip code. It's not just counting up naively, we send 1,000 letters to this zip code. We send 1,000 letters to this zip code, and they have a lot of friends in zip code C next door, and we sent, 2,000 letters there. So we want to factor that in. That's kind of the idea here. And just to illustrate why this might be relevant, this is an example we took from Bailey. You can see on the left, if we look at the zip code for San Francisco, obviously a big urban zip code, you can see with the darker shade, there's a lot of links San Francisco has just across the country, east, probably a lot of urban centers, right? Yeah. But if we look at a more rural county in the same state in California, which is on the right, that's Kern County, you can see the links tend to be more focused on the west. And you might see a little blob in Oklahoma a bit because of, migration patterns and so forth. So, if we just ignored this, we're missing out on all this detail here, which is why we think it's important to include. And as another example, here's zooming into ZC area. On the left, you can see just if we were to just naively take the count within each zip code, we'd have those, the yellow is kind of the higher number of notices being sent out. But when we factor in these links, we can kind of smooth it out, make it a much cleaner analysis, right? And better reflect, I think, the reality of how this information will flow between taxpayers. All right, so I need to go over the models a little bit. So this is just the IV, the high level, very simple model. We just take the budget, that number that's ultimately driving all these programs as our IV. And this is just the high level kind of for each zip code, calculating that intensity of treatment. And again, there's our three that we're focusing on here, the ACS letter, CP59, and field. And then once we have that in the first stage, also this includes just some basic year and zip fixed effects. Once we have this in the first stage, we go and plug that into the second stage model. We take those predicted values, and then we take a vector of controls, which is this X IJT here. We continue to include the year and zip fixed effects. And this is where we drill down, of course, to the individual level, right? And so P is what we're predicting here. That's our outcome. And it's just an indicator for compliance. We set it to 0 if they fully file and pay on time, set it to 1, essentially, if they're a late filer, and set it to 2 if they, had an outstanding balance due after the next year. So they, they didn't fully pay on time. Yeah. Yes, okay. And the OLS, which is for the dollar change, this is where instead of the P, we've got the U. This is just for taxpayers that did end up owing money. How much did that change based on the intensity of our treatment levels? So it's pretty much the same model, but it's OLS instead of this multinomial. So I won't talk much about it here, but it's, we use the first notice balance to calculate, what your balance was. All right, so what are our controls? Got to mention these. It's kind of the usual suspects, right? We have filing status, your total positive income. We looked at how, if you were a frequent timely filer, essentially, in recent years, we look at how much of your income is subject to withholding, the activity code, the DIF score, which is, a model that measures kind of your risk level. So I don't think any of these would surprise anyone, but we got to mention it. One thing I didn't touch on is, we have, you might notice we have T-1 here. So we're generally just taking the prior year to predict the current year. Yeah. All right, so this is a bit of evidence of why we are happy with using the socially connectedness index version. So I know I said we did 0, 1, 2, but in order to simplify and get away from the multinomial here, this is collapsed down to just 0, 1. So 0 compliant, 1 not compliant, which means a negative sign is good, right? We're getting closer to compliance if we get a negative sign. And you'll see if you look at the left column, which is our final model, the SCI weighted, you're gonna get larger results. We better capture the effects when we incorporate this into our model. If we were to just do a naive distance, so we only looked at the distance between zip code pairs, we're not capturing it as well. So the magnitude of the coefficient goes down. And if we were to not use weights at all, like just look only within your zip code, how many letters went out, it's even smaller. So we're missing a lot of those effects if we don't somehow account for these social links, which the indirect effects can spread through. And there's no perfect way to do this, but we feel like the connectedness index we use from Bailey is the best we've got so far here. So here's some of our results for the multinomial. I don't want to spend too much time on this. It's a big table. But again, negative is good. That's closer to compliant. We generally had highly significant results. I mean, we're kind of cheating in a way because the sample size is so large, right? So, you know, that's part of the issue. But, and you'll see the largest effects, as I had said previously, for ACS letters, followed by the CP59 and the field notices. And, you know, we're generally getting expected signs here for the controls as well. You know, what we would have hypothesized is generally coming up. Again, the P equals 1 in the left column, that's the late filing, and then P equals 2 is the people that didn't pay fully. Yeah, okay. Again, that was like log odds, right? You know, the multinomial is kind of weird to interpret. So this is, we did a calculation for average marginal effects for a change in 1,000 notices. So this is kind of the extensive margin, right? Because we're looking at a probability of compliance. And so, you know, just a quick bit of analysis, we would say if we increased 1,000 ACS letters, for example, we go to that top left cell, we'd estimate, or I guess we should say the intensity of that program, because it's not just in your zip code, it's the links, right? We'd get about a 14% reduction in probability of late filing and a 25% reduction in probability in failing to fully pay. And then we wanted to boil this down into a smaller table. We did some quick calculations for what if we did a 10% increase. So this is like a relative change. So the previous side would be more like an absolute. This would be like a relative. And relative meaning to the kind of average level over our study period. And so if we were to bump the ACS letter volume up about 10% from where it generally was over this time, it seems small. We'd only go down, your chance of late filing would only go down 0.3 percentage points. But remember, there was only like 2 or 3% that ended up falling off the wagon anyway. So that actually translates to about a 15% decrease. And similarly, you know, for the chance of, it's even better when we look at the chance of having an outstanding balance too. So fully paying, in that case for ACS letters, it's a half a percentage point decrease, which translates to a 17% relative decrease. And, you know, similar for CP59, again, it's significant and substantial, but smaller. And field is significant, not really that substantial though. But that's also a much smaller program. You know, we have a lot fewer people knocking on doors than we have letters going out. All right, and so here's the dollar change model, the OLS. And so this is for the taxpayers, you know, again, the previously compliant taxpayers who the prior year filed and paid on time. This year they didn't pay on time, but how much smaller was the balance that they ended up owing due to, you know, our treatments. So again, we're getting pretty good significance here. In this case, the field kind of dropped out a bit. It's only got 1 star. That's not really good enough. But we're still getting, you know, the expected sign, negative, again, good. Fewer dollars that the taxpayer hasn't paid. Yeah, and this would be kind of like our, God, did I screw the word up before? But this would be like the intensive margin, right? So how bad is the problem in the event that you know, ended up owing money? And I wanted to boil this one down too. This kind of combines both, right? So this is, if we were to bump the programs up by 10%, how would that affect, you know, the total amount of dollars that, like outstanding tax due that would be reduced, right? And so this includes both the margins. So this is not only from people who might have ended up owing money but didn't, thanks to our programs, but it's also people who did end up owing money, but probably less than they otherwise would have, thanks to our programs. And so, you know, again, these effects total for ACS letters over 3.5 billion, which is about an 18% decrease. For the CP59 notices, it's about 1.1 billion, 6% decrease. And again, field, you know, it's small, but it's significant. Well, actually less so here because the dollar change model wasn't so much, but it's still the right direction. So what do we take from this? So obviously these are substantial indirect effects, right? We saw the biggest impact from ACS letters. We are hypothesizing that's because they have the greatest reach. It's like there's benefits to scale, right? You know, these letters go to more zip codes than the CP59 notices or field visits. There's just a higher volume of them in general. So, you know, it seems like the bigger we go, the more benefits we have because of these indirect effects. And, you know, even just the 10% increase led to substantial improvements, right? So, and we think these should factor into how the IRS chooses to, you know, allocate the resources that come in through IRA. And it's worth considering, you know, it's important to acknowledge the social channels that these letters can, or that our treatments can flow through, right? Yeah, so thanks. Oh, and if you want to check out the references later, they're there. And then I'd like to invite Will to come up to give his discussion.
All right, so I'm very excited to discuss these papers. I think they're all really exciting and novel. But before I get there, the quick usual disclaimer is that these views are mine and not my employer's. These papers, they're all really novel. They're trying to do bold, exciting new things. And there are a lot of challenges you encounter along the way when you try to push the envelope like that. So I think a lot of the discussion comments are going to sound negative, but they're more along the lines of how are ways we can do a little bit better as we're pushing the envelope in these exciting new directions. So on the first paper, talking about this gravity model, I've titled this slide, Escaping the Gravity Well, because I don't think this is really a gravity model. I think that it is a gravity-inspired model that has been adapted much more carefully to the exact setting you're looking at. So, you know, a gravity model has a mass term. As Michael pointed out, you don't have a mass term here. So this really fundamentally is not like a gravity model. I mean, you could actually envision adding one, and I think you should, and try out the fit with that. So if you added GDP, say, or a different measure of the size of the potential financial flows that could be moved, say, out of a source country, you would actually do a much better job of predicting total flows if that's the objective. We'll talk later more about objectives here, but I think that's one of the pieces of the paper that didn't come through very clearly when I read it, was what problems are we trying to use this measure to solve, and that'll inform exactly what kind of model we want to have. Okay, so it's missing a mass term. It's also missing a distance term, or rather, it has a very strange distance term, because gravity is symmetric, and it's applied on this Newtonian space, whereas here we have a distance measure that is very much not symmetric, and that is applied on a very non-Newtonian space, because exactly which pathway you choose through space will determine a huge amount of the factors in the model. So I think, you know, actually, this is much better than a gravity model would do. And I think actually one of the things you could do is you could make a comparison. So you could actually prove this by taking a very simple gravity model, estimating goodness of fit with your data. You could take your model constrained to sequences of length 2, and you could fit that to the data. You could take your model with sequences of length 3. You could take your model and add a mass term, and you could stack up the adjusted R-squareds or something else and make a comparison and say, actually, if we want to understand these flows, look how much better it does if we do this pathway instead of, say, just the sequence 2 pathways, which miss the conduits, which are very important for this kind of behavior. My next point is we really need to drill down into what are the questions we're trying to answer. So like at present, it's sort of describing which sequences of countries are advantageous for tax avoidance. But the readers are going to ask, why is that answer useful to me? Like, what is the implications of the answer that you get? And I think, you know, at one point in the paper, there's a sentence about the problems the model is trying to solve. And I think it would be really great to spend more time motivating the paper with the problems that it can be used to solve. So the specific sentence is that you mention identifying foreign countries that may be omitted from returns that list other foreign countries. And I think actually, like, taking a step back and saying, okay, so we have individuals, we have businesses, maybe small businesses, maybe very large MNEs. Whose behavior are we trying to model here? And you might get different answers for different ones. You know, very large corporations, they're structuring things in a way where, okay, maybe having to set up a chain of subsidiaries is a reasonable cost to incur to do sort of a multi-step process that gets us very large benefits. But maybe for an individual, you're really thinking about the disclosure rules are much more important to me relative to say, the capital gains rate. So you could model separately individuals or businesses. But you could also say, actually, like what we're really trying to do is to capture the aggregates. And if that's the case, then you definitely want to include things like, well, what's the total source country profits estimated to start out in, say, the origin country, and focus more on that kind of a question. So I think basically the paper will take directions from the problems it's trying to solve. And if you give the audience a hint of what the problem is they're trying to solve, then all along when they're reading the paper, they're going to say, oh, I see why they're doing that. They're trying to solve this problem along this way. So that's basically sort of, that will motivate and excite your audience to care more about the details of why you add sequences of length 3, et cetera. And then finally, the great advantage of structural models like gravity models traditionally is the ability to do counterfactuals. The really simple Newtonian counterfactual is you can very simply calculate if the moon were 50% further away from the Earth, how much smaller would the gravitational force between the moon and the Earth be? And you can do exactly that kind of a counterfactual here with, if your model lends itself to a structural interpretation like that. You could say, what would happen if all countries had a minimum level of exchange of information? What if they all had full transparency and we remove that term from the, we set that term, equate that coefficient to 0 and we see what the predictions of the model are for the differences in flows? What if there were a minimum capital gains tax rate applied in all countries? Instead of having a lot of countries with 0, what if we had 5% or 10%? How much smaller would these flows be according to your model? And you can really lean on it and say, well, what if there were no withholding taxes? So that takes away one of the major reasons to structure your financial flows through a conduit country, is because the conduit country usually functions as, okay, a country, your example, Japan, Japan, if you take dividends from the United States to Japan, they're not subject to withholding taxes, provided you have enough ownership. But then you can take them from there to somewhere else that has a lower capital gains rate. Well, if you don't have withholding taxes at all, then you don't need the Japan link in the chain. You can go directly. And so it would be very interesting to see how your model predicts behavior would change. Maybe that's pushing too hard. Maybe the model will give you some really bizarre answers, and that will actually tell you about the ways in which your model might be misspecified. So I think counterfactuals is something I would love to see as an extension to this. Okay. On to this paper on art, which I think is really cool and exciting, has a lot of really interesting facts and descriptive statistics in it, has a lot of estimates in it. I enjoyed getting to see the estimates. I think there are challenges with some of them, of course, but it's really neat to see all of these different pieces. I think one of the challenges when I was reading the draft was just following along with what is and isn't legal here. And I think, there are lots of gray areas in this space. And so it helps us to be clear about exactly what are and are not the requirements. So, my first question, which the paper sort of talks about a little bit here and there, but could just be more clear and upfront about, is what are the reporting obligations? So the Form 990 instructions actually say that according to the accounting standards, museums and other organizations that elect not to capitalize their collections shouldn't report an amount for the amount of works of art and other collection items that are donated to them. And likewise for Schedule D and Schedule M. So basically, there's this huge amount of organizations that are not reporting in compliance with a particular item of the accounting standards. And another piece of this is, what are the potential consequences if you didn't report? Why? I think it would be helpful background to know how much TEGE is going to come after you for this kind of behavior if we're going to talk a lot about exactly what does get reported. I think the question is, why would you report or not report? And I think having some understanding of what are the consequences of failure to report would be very helpful. Okay. So more background. I liked the audit flag. It was nice to have you, when you threw up all the audit flags here. In the paper, it was very hard to figure out what the audit flags were until I got to the appendix. So I think that should be in the body of the paper. But also, if you look at this list, diversion of assets, political activities, those are very different kinds of activities for a nonprofit to engage in. Unrelated business income, that's the kind of thing that the big universities and hospitals tend to have a lot of, right? But then access benefit transactions or loans to disqualified persons. Well, those are the kinds of things that very small family-controlled nonprofits tend to have a lot of. excess compensation, maybe more like the excess benefit transactions, or maybe it's the hospitals paying their really high paid executives, right? And that actually might be somebody who's running a multi-billion-dollar business who makes a very large salary. Finally, foreign grant activity. Foreign grant activity, again, is going to scale with size, right? So each of these things is going to not just make it more likely for you to be audited, but say something fundamental about what kind of nonprofit are you and what kinds of challenges and compliance risks do you have. And so rather than throwing them all in a bin together, split them out, look at them separately. Say, oh, the kinds of nonprofits that engage in the kinds of stuff that suggests it's a small nonprofit, it's run by a particular family who maybe are cutting corners with some of the rules for how much you can and can't provide benefits to the members of the family who donate a lot of the money to the nonprofit. Are those, what's the patterns with the art donations there versus art donations to really big, huge, nonprofits that are generating tons of unrelated business income? And I think it would be very, you talk broadly about the descriptive statistics, but actually thinking about what are the 2 or 3 most salient sort of stories or categories and doing deep dives on each of them would help build a narrative, as opposed to putting up a table where I can say, oh, well, it's higher for this kind than this kind, but I don't actually understand why. Helping to build a narrative, another small thing in the text is there's a bunch of comparisons that are not apples to apples on the units or on the stocks versus flows. That's something that's easy to fix, but I would love to see that. And then, so I think, both a commonality this paper shares with the paper Brett presented is that they lean heavily on trends in IRS enforcement funding. And, I think there are just a huge number of problems with using this as an instrument. So to state the exclusion restriction here, we're saying that last year's audit rate for nonprofits only affects behavior this year through the change in audit probability due to audit flags. Well, the probability of audit, even without audit flags, also changes, right? Tons of other things change when you change basically how much enforcement there is in the space. And so nonprofits are going to respond accordingly. And there's just a lot that can go wrong with that kind of an approach. And also, audit rates, if you looked at Brett's graph, audit rates are just this straight line trending down over time, right? A linear time trend can explain so many things, right? It's very hard to say actually that the linear time trend down in enforcement is driving things as opposed to anything else that's growing or falling over time. And so, the time trends, I think actually, instead of leaning on time trends as an instrument, both of these papers would benefit from instead using time trends to tell a narrative, tell a story. Brett had this great graph of what happened to a bunch of enforcement categories and a bunch of behaviors over time. I want to see, here in 2006, this one falls through the floor. And then what happens in 2007 to the very behavior that one targets? What happens in 2010 with this other thing? I'm telling a story with those trends over time is actually a really interesting and important contribution you can make, because I study this area really intensively and I don't know those stories. So if somebody could tell me those stories, I would learn a lot. And I think that's very true here with the art too. Telling the stories about what your time trends are, even in this paper that's descriptive in an area where we don't have any other alternative work, just would be a big contribution relative to what already exists. So getting onto this final paper, estimating network effects, which this paper tries to do at the zip code level, is hard. In fact, it's exponentially harder than estimating direct effects, as a large literature in statistics explores. It turns out that this is not an area where an RCT solves your problems. In fact, having worked on one of these RCTs, it turns out that actually Arano and Sammy point out that there's an aggregation bias in the published papers that I and others have written in this area. They're not specifically talking about our paper, but basically they find that heterogeneous treatment effects lead you to need a weighted rather than an unweighted OLS estimator or an alternative estimator. So actually you should check this paper out. And that's even in these RCTs that are doing everything they can to control for network degree. So they basically show in a simulation that this all falls apart with an RCT. And you're trying to do this without randomization in a setting with selection into network treatment, with selection into intensity of network treatment based on where IRS decides to spend its resources. You're setting yourselves too hard a task here, I think. And, you know, I understand that the service is super interested in indirect effects. I think they're really important, but I also think because they're so hard, the ability to tell, you know, a story that people outside the service are going to latch onto and trust enough to give the service more money on the basis of, oh, these indirect effects are really important. The standards you got to get to are just really, really challenging. So, you know, one sort of switching gears a little bit, reading the paper, I think it would be very helpful to write for a broader audience. So actually, you could, instead of calling them ACS notices, call them something very specific. Call them collection system notices of deficiency or whatever, you know, a descriptive term rather than an IRS term of art. And similarly for the CP 59 notices. You know, it would be very helpful to have a flow chart that talks through what happens before and after these steps in the enforcement process. I think I may be one of your very few readers who's not at IRS who has some sense of what that process is. And even I was murky about exactly where ACS fits in. So like, you know, ACS is after the 4 initial notices of deficiency, but it's before field, right? So like, even that basic background would just be very helpful. And in general, you know, where you can, don't use IRS jargon. I think this is an easy trap to fall into because we start off talking about these papers with our colleagues who understand all the jargon. But if you can take a step back and explain for somebody who doesn't live in that space what it means, then you're starting to get to, okay, this is a story that maybe is more airtight and also like conceptually makes more sense. All right. So my third point about the wagon paper here is you've gone from 0 to 60 in terms of estimating network effects based on intensity of treatment for a whole bunch of different zip codes. But along the way, you've skipped looking at sort of simpler building blocks that are parts of, that inform those estimates, that provide context for those estimates. So like direct effects. It would be really great to have an estimate of direct effects in the paper to help me figure out what's going on with the scaling. Like, also, maybe whatever strategy you're using for the direct effects, somebody might trust that part of the paper, but not the effects of intensity of treatment across zip codes across the country. So like, you include not only the intensity of treatment in the same zip, but also this connectedness across zips network in your specification. It would actually be interesting to see how things differ if you just do intensity of treatment in the same zip versus across all of them. And then finally, as I said, when I was talking about time trends before, you know, you're requiring that all other enforcement has no deterrent effect, which I'm not sure is an assertion you really want to be making in this context. There might be choices that leadership is making about where to cut that are going to engender selection concerns. And zips where enforcement falls most had high pre-period enforcement, and so it might have different trends. And likewise, the common economic shocks are going to hit connected zips similarly. So there's just a huge amount of toughness there. But thinking about the future, what would the rocket ship look like instead of the wagon? The rocket ship would be an experiment here. And you could do an experiment in collaboration with the enforcement divisions. What would that look like? You would block randomize, say at a very large geographic level, you would block out, and in some large area, you'd do, you know, intensity of treatment randomized. You'd pre-register the design and the analysis plan. And then when you do all of this, what you get is something that people really trust the answers you arrive at. And that is a much more, much bigger contribution than something that, you know, it's exponentially harder to do than something that's, you know, just using data that's already been collected. But it's exponentially more powerful for convincing people about these indirect effects, which are so difficult to measure. So thank you.
Okay, we'll start a question and answer session. I'll start with an online that we have.
Wait, do we get to answer? Don't we get to respond?
Oh, are you responding first? Are you?
can respond, Mike. Yeah, go
Yeah,
ahead.
great.
Go for it.
Please.
So, I just want to say thanks for the comments because they were super. And there is one little point that I did want to bring out because he triggered it. He said, well, okay, maybe it's not a gravity model, but what would the gravity model do for what the dependent variable was? And of course, we did all that. And it's interesting because, as I said, when we just do a plain old trade gravity model, we have an R squared of about 0.65. So when we did this gravity model, which has this concocted foreign direct investment path, all right, and we just used GDP and distance across the sequence, all right, so now we got multiple countries' GDP, and we keep our variables, our tax administration model, all right, we get an R squared of about 0.65. But the coefficients on GDP and distance are not 1 and 1 and 2, they're less. And so it's a really great point because what it basically says is a lot of foreign direct investment is synonymous with a tax motivation. And that's essentially, so that will be in the paper, right? That's really great. And so of course then we also have the other thing, which is what's the responsiveness of having an information exchange report or the responsiveness of changing the withholding tax rate. And we have that, but it's not clear we can get that out of the building, as I think IRS people say, right? So great comments.
Yeah, want to respond, I guess? So, I mean, thanks for the comments. I don't, to be honest, I kind of blanked on everything. So,
Sure.
I wrote it down, so I'll think about it later. But yeah, no, I think there were a couple things that you mentioned that I've been thinking a lot about too, like especially the IV. I mean, I don't want to say I know it fails the extraction, but and like under incredibly strong assumptions, does it work? And
yeah,
practically those are great, but it, you know, it is what it is. There's not a lot of exogenous shocks to art out there in the world. So
yeah. As usual, what I'll say is that there were a bunch of my comments that were about things that were not clear in the papers that were much clearer in the slides. And you did a good job with that one in particular, too.
Awesome.
Yeah, I'll just say thanks, and yeah, especially for recognizing the challenges we're trying to address here, which you probably know better than I, but yeah, thanks. Yeah, go ahead.
Okay, I'll start with the question. I'll start with an online question. For Matthew, it would be useful to know robustness to omitting UBI from the audit flag definition. Museums almost always have UBI. Also, UBI and aggressive fundraising, tolerance for inflated art values are likely correlated.
okay, I mean that can be done. There's a lot of robustness that didn't make the table, or I'm sorry, the paper. But I mean, generally in presenting this, I've gotten like everyone wants to see a different cut of the data, so it can be done, yeah.
Any questions out? Oh.
Hi, question for Brett. On the field results, you weren't showing much of a result there, and I wonder how to think about possible interaction effects among the treatment streams. Does the field maybe act as a backstop for some of the letter treatments, that if there could be an escalation to a field, or if that's a can the treatments support each other in some way?
Yeah, I would say that's possible. We haven't looked at it much. We're planning to expand to, we looked at IMF here and the compliant population, and we're also going to be looking at taxpayers that were non-compliant in the prior year. And we're also hoping to expand this to BMF taxpayers. And we're expecting the field will play a much larger role for the BMF side. Yeah, but yeah, I don't have a more specific hypothesis to offer there for what we see in the IMF. It's important to remember that, there's also a direct effect, right? We didn't look at the direct effect in the slides, right?
I think to John's point, like maybe considering like the population that was previously compliant are not the kinds of people who field is like the last step in the chain, right? Mm-hmm. For the most consistently non-responsive, non-willing to pay their tax debts people. Maybe you're just like, there's not a lot of tend not to be the same kinds of people. And so like, they're usually responsive by the point it gets to field, or the ones who are very strange, who fall completely off the wagon, are just not going to be responsive at the field stage. Like, that's a possible interpretation.
Yeah, that makes sense.
Another one for Brett. As I understand it, your non-filing indicator or late filing indicator is capturing the propensity of people who had been timely filing and slip into late filing.
Mm-hmm.
And that your negative coefficient you interpret as a good thing because it's reducing that. But it wasn't clear to me how you were controlling for the possibility that instead of late filing, they were not filing, which would be a bad thing.
Right. Non-filers would be, yeah, they would fall into that as well. It's kind of, I guess you might think of that P equals 1 as not filed on time, right? Yeah. So they'd be included in there. For the ones we know about, of course, because we don't know all the non-filers. We know the ones we get the information returns on, most obviously, but yeah, we don't have that for everybody. Yeah.
Okay, I think we have time for one last question right there.
Yeah, question for you, Michael. Question for you, Michael. Appreciate your work on gravity model. How would the gravity model behave if, let's say, G20 adapts a flat tax of 15%?
Right. So the way a change in a domestic tax would enter into the gravity model would actually be in that term in the numerator that we're using the capital gains tax as a proxy, but on the corporate side we would just put the minimum tax, and what it would do is it would make that sequence much less attractive for a tax avoidance motive. But that's how we would actually slot it into the equation.
Okay.
There's one over there. Well.
One more question.
I'd like to ask a two-part question. There was a period in the recent past, there was much talk that the Biden administration wants to support a lot of IRS audits, and the Republicans were dead against it. What's the situation on that? Did you get the IRS get the funds that was supposed to be given to hire additional number of auditors that the Republicans were afraid that their people would be audited by IRS? That's one question. And the second on tax avoidance, not being a tax policy person, I'm glad to know that tax avoidance is legal, whereas tax evasion is illegal. Now, at what point does the IRS criminal division would think the tax avoidance that's going on would become illegal activity?
Who wants to choose that? Maybe we let the Treasury person talk.
All I'll say is that we're very interested to see what the IRA money that the IRS has received, how that plays out, what IRS does with it, and what the results are. I think that that's probably a good way to wrap this session up, actually.
We'll be breaking for lunch now, and please be back at 12:50 for our keynote
Those were great comments. Okay, so we're using the gravity model as an analogy, but I totally agree. And so
so there's no computer here.
No, but
Oh.
your slides will be right there.
Oh, so I can see from
So
here.
you can see, yeah. So we encourage you to.